Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures trying to stage a rebound this morning after the S&P 500 closed in the red for the fourth consecutive trading session. The stock sell-off led by mega-cap tech names, with the Magnificent Seven cohort officially falling into correction territory, while sectors like consumer staples outperformed.
But the big focus today is Nvidia. The AI chip giant's earnings have become one of the most important events for Wall Street, and its latest results may actually be the most critical yet. Options indicating that the results could fuel a move in the stock of up to 8.5% in either direction. Now, the earnings report coming after DeepSeek scrambled some of the outlook for AI infrastructure. This is also the first time since 2022 that Nvidia will report earnings with shares down since its last report.
And odds of tax cuts are rising. House Republicans passed a budget blueprint calling for deep cuts in safety net programs such as Medicaid, paving the way for $4.5 trillion in tax cuts. The budget blueprint is the first step in a process that allows Republicans to bypass Senate Democrats on legislation related to taxes and spending. But its passage does not guarantee an extension of the expiring 2017 Trump tax cuts. The measure was passed with a 217 to 215 vote, with only one Republican opposing and all Democrats present voting against it.
U.S. stock futures are pushing higher this morning after the S&P closed in the red for the fourth trading day in a row. Of course, we take a look at some of that risk-off sentiment that has swept the markets. We are looking at some buying action here ahead of the open. You do have all three of the major averages on track to open the day in the green. Of course, the big focus today is going to be Nvidia's results. It's going to be driving much of the sentiment that we are going to get. It's going to be a little bit of a break from some of the worry that we have seen creep into the broader markets here surrounding U.S. growth and what exactly that means following a string of some of that weaker than expected economic sentiment numbers that we've gotten out over the last several trading days. So again, going into this report on Nvidia, a lot riding on this. Obviously, the implications here for the broader market. And Brad, you mentioned it, or we mentioned it there at the top, the fact that this is the first report since 2022 that Nvidia is reporting results and shares are actually down since its previous earnings report. So again, just a lot riding on this, whether or not they are going to be able to maybe regain some of that lost momentum.
Yeah, you mentioned it. I can't take credit for that one, but all these things considered,
we mentioned it.
It's going to be a massive report. Yes, exactly. Here, it's Team Smith here this morning on Morning Brief and every day. But one of the major areas that we've seen within this sell-off kind of catch the eye of some of the larger institutions out there and money managers is where else globally they're seeing some appetite for equities here. And European stocks, BlackRock was calling that out early on in this week. They still think that U.S. equities can outperform in 2025, led by tech, even as Europe's start to the year was strong here. But they're broadening their risk-on view, and many of the firms similar to BlackRock kind of upgrading their Europe stocks outlook. But it does come back to Nvidia, and not just what Nvidia is saying about demand right now, but also more broadly internationally. And that's where we could get even more of that correlation between how some of the other firms are looking at the global picture and what's taking place through the eyes of Nvidia. And speaking of the aforementioned Nvidia, NVDA shares right now up pre-market ahead of its results after the close today. The stock is expected to move 8.5% in either direction following the results, according to Options AI data. Now here with the street and their expectations from the earnings report, we've got tech editor Dan Howley here. Dan, what do we know?
Yeah, Brad, this is going to be obviously a massive report for NVIDIA. This is something that I think the entire tech industry is trying to just prepare for, whether or not they beat, whether or not they beat and raise. Guidance has been very important for NVIDIA stock over the last couple of quarters. And I think, let's just look at what the numbers expectations are real quick. We're looking at adjusted EPS of 84 cents. That would be a 63% increase year over year on EPS, and then revenue of $38.2 billion. That would be up 73% year over year. I want to point out real quickly, when you've looked at how the stock has performed just immediately afterwards, it's tend to drifted downwards just on I think how people are responding to the year-over-year growth numbers, because we're coming off massive year-over-year growth. So the comp is not necessarily in NVIDIA's favor. And so if we look at the last year, Q4 last year, their EPS was up 486%, and their revenue was up 256%. So it makes that 63 and 73% look pretty paltry in comparison, though I'm sure any other company would kill for that. But what we're really going to be looking at is any kind of commentary we can get around guidance. As I said, that's been a big kind of indicator for NVIDIA, as well as push in the direction of the stock. That could also start to move the likes of Microsoft, Google, as well as other chip makers, AMD. The other that we want to talk about is cloud segment. In the CFO commentary from Colette Kress, she mentions how much of their revenue, their data center revenue, is coming from cloud companies. So those are the Microsofts, the Amazons, the Googles, the Metas, what have you. Last quarter, that was 50%. There's been talk, murmurs of Microsoft maybe moving some of its spending around, although they've all said that they're going to push spending well into the tens of billions, and in Amazon's case, $100 billion this year for AI. So we shouldn't see too much difference there, although you have to wonder, these companies are trying to develop their own chips. They're leaning on other companies. They want to ensure that they're not beholden to NVIDIA. So as that kind of matures over time, what does that then mean for NVIDIA's cloud growth as far as the revenue from those providers? And then on tariffs and export controls, this has been something that's been just at the back of everyone's minds, I think. The tariffs, obviously, Trump's discussed 25% tariff on chips. And then the export controls, there's been talk about pushing harder export controls on those H20 chips that DeepSeek used to prepare its own AI models. And that kind of sent the entire AI trade into an uproar when that was announced. So those are really the main things that I think we're looking at just overall. And I think when it comes to this company in and of itself, it obviously is the bellwether for the AI trade, and it's going to potentially move around the other big tech giants as well, just because they're so embedded in AI at this point.
Yeah, we certainly have seen that in the options pricing, at least just in terms of the direct moves that we could see right after. Hallie, great stuff. You got a busy day ahead of you.
Oh, yeah.
I'm going to let you go prepare even more at Hallie, thanks. Let's stick with Nvidia because it is the closely watched results, and this comes amid DeepSeek-fueled AI spend skepticism and chip export control concerns. Those fears have pressured tech stocks in recent weeks. Now, heading into this report, Nvidia shares are down nearly 6% just over the last 5 sessions. Joining us now on what to expect, we want to bring in James Chakmak. He is the Chief Investment Officer of Clockwise Capital. James, it's great to have you back here on Yahoo Finance. So what do you think of that we are going to hear from tonight's report? And just put it in perspective for us, just how important this report is for the broader market.
Yeah, sure. Good morning. It's very important, as you guys outlined. And here's the good news. The good news is that you're probably going to have a nice beat on revenue and a nice upside to the Q1 numbers. By our estimate, about 5% on both. So, you're going to have a very solid result. The question is, the bad news is that a lot of people already are pricing that in. And then obviously you have some questions around the gross margin. I think that, you could be in a situation where the reaction to NVIDIA could bifurcate from the reaction to the broader market. So long as you're seeing the revenue continuing to grow at that healthy clip, that should instill confidence in the broader markets that the trend is still going in the right direction, despite the expectations not being excessively surpassed based off of the current consensus numbers.
Pre-market move higher here. Year to date, stocks down 8%, though. Is this a buy signal?
No, not until we get the numbers. I mean, from our standpoint, we were trimming the stock in the 140s. Right now, it's about 8% of the benchmark. We're about half of that as it stands right now. There is a lot of risk. You can't sugarcoat it. But the good news is that expectations have come down significantly over the last 2 weeks or so. So, the setup, we think is incrementally starting to skew a little bit positive, but not positive enough where you want to, you want to bet the farm on it.
When expectations get lowered for NVIDIA, what type of warning sign or red flag is that even for the rest of the semiconductor landscape?
Yeah, it's a warning sign for sure. But the good news is that we have a lot of the customers of NVIDIA coming out with very high guidance on their on the CapEx side. From Microsoft, Amazon, Meta, they all upped their capex guidance numbers for 2025, and so the spend is still certainly there. In our view, that spend could come down over the course of the year, lower than the bars that they had set, which is why you got to be careful with the chip makers. We personally at Clockwise are increasingly putting our assets into names like TSM, ASML, over a name like Nvidia, because we think that the demand is sufficiently there while you have a lower bar in terms of expectations.
James, what is the upside then, or what does the opportunity look like then in those names? And I guess for investors out there trying to evaluate whether or not it is still an attractive time to buy Nvidia, obviously tonight's results are going to give us a little bit of clarity, but what would give them that green light signal?
Yeah, I think you got to have revenue beat in excess of 5%. If that's the case, the numbers will come up across the board. You can extrapolate that earnings power. I think that if it's in excess of that, I think you're going to have another bull run in the market here. We're not sure if that's going to be the case, which is why we're slightly more cautious. But even if they met those expectations, that could be decent for the broader markets. That demand isn't falling; it's just not growing in excess of what by the margin and degree that they've been beating in the past.
James, thanks for taking the time here with us pre-market. We're going to continue to track these moves even after the results drop. Appreciate it.
Sure. Thank you.
House Republicans' President Trump-backed budget bill narrowly passes with a slim 217 to 215 margin, paving the way for sweeping spending cuts and $4.5 trillion in tax cuts. Our very own Rick Newman joins us now on this. Rick, your analysis of this entire bill that made its way through.
It's a first step. So those numbers that you just showed, those are the baselines. It doesn't say what the tax extensions or tax cuts will be, and it doesn't say what the spending cuts will be, and that's going to be the hard part. So just to go back to it, Brad, you said that you just showed $2 trillion in spending cuts that are going to have to be part of this bill. So that is over 10 years, so call it $200 billion per year. That's hard. It's hard to cut that much spending, and there are not a lot of places you can do that. So in order to finance the extension of these tax cuts and some new tax cuts, it's looking like there are almost certainly going to have to be sizable cuts in Medicaid. That's the health program for the poor, and then also in perhaps things like Pell Grants or food benefits also for the poor. That's just where the money is. And that's assuming that there are not going to be any cuts in Medicare or Social Security. So this is the House's version. The Senate has a different version. There's still a long way to go to get actual legislation that President Trump might be able to sign. And it's still not clear whether Republicans in the House and the Senate will agree on what those spending cuts should be. So that's going to be the drama on Capitol Hill for the rest of 2025.
And Rick, on the geopolitical side, we're also getting some news developments here. Most recently, the Ukrainian government confirming a drafted agreement with the U.S. for the country's rare earth minerals, and this would come in exchange for security guarantees. What can you tell us there and the steps forward that this could potentially see here for ending Russia's invasion?
I don't think it's going to end the invasion. I'm not sure anything is going to end Russia's invasion. We should all be very skeptical of talk that Russia somehow will agree to just stop the war they started 3 years ago. This deal on minerals is really interesting. I mean, it looks like Ukraine, led by Vladimir Zelensky, the president, is like learning how to speak Trump's language. Trump wants a deal. They're like, okay, we'll make a deal with you. I think there are major questions about what this deal would actually be, assuming it is going to be a real deal, so that the United States gets access to whatever Ukraine might have, lithium, titanium, that's the kind of stuff we're talking about. What does that mean? Does that mean the U.S. government has those rights? Does that mean the U.S. government secures those rights on behalf of American companies? How does that work exactly? I mean, a lot of unanswered questions. But, Zelensky is pretty crafty. And I think I love the fact that he's just like, okay, Trump is a deal maker. He wants to be able to say he made a deal. I'll give him a deal. Whether there's any substance to this deal remains to be seen. But Ukraine and Zelensky are hanging on for now.
All right, we will see. And he's expected to travel potentially to Washington on Friday too, right?
Yep.
All right, Rick, great stuff. Thanks so much.
Hi, guys.
Well, coming up on Morning Brief, we're going to count you down to the opening bell on Wall Street. Plus, Super Micro shares, they are surging after reporting its delayed financials. We got those details ahead. You're looking at gains of 20%. Plus, full coverage, of course, of Nvidia as Wall Street awaits the most critical earnings report here, potentially, of the earnings season. We've got all that for you coming up ahead on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Super Micro Computer reporting its long-awaited financial results just ahead of the Nasdaq's delisting deadline. The AI server maker had delayed filing in August after a report from short seller Hindenburg Research alleged accounting red flags. Nasdaq granted the company an extension after its former auditor, Ernst & Young, resigned in October here. There you're taking a look at shares which have largely been moving just on the deadlines that they've been trying to kick the can and essentially have been able to successfully kick the can down the road. And now, finally, we get some evidence coming forward of how much they actually made during the quarter that was in question here. And it seems like for the results that now have a new auditor that they are working with, they are back in compliance here. The company essentially saying that they were able to meet this deadline. And now we have finally a look at some of their assets, which sit at about 10.8, what looks like $10.8 billion at this juncture. But more largely going forward from now, I think the question is about what their customers think about doing business with them as well and how they continue to retain those customers as well.
Yeah, I think this offers a bit of relief. I think there's more remedies, obviously, that are necessary. That was one of the things that were highlighted in this report. And of course, when you take a look at the quick reaction that we are getting from the street, there's lots of questions that do remain unanswered when it comes to some of those financial controls. Obviously, we are seeing some improvement there, but what exactly that steady improvement could potentially look like here in the weeks, months, quarters here to come. So leaving it open, I think, to some risk out there right now. And I think that very much you can see still reflected in the stock price, even though we are looking at shares up just about 19% today. We're still a far cry from where they were just about a year ago here. And so we are seeing a bit of a relief. Very much this was expected, I think, if they were to file, obviously, by yesterday's deadline. But you can see over the 1 year, the stock's still off just about 47% and wasn't just shy of 120 just about less than a year ago there last March. So again, it's going to take a lot to get back to that momentum. Obviously, when you take a look at the macro picture, AI demand, the fundamental part of the story, that looks strong here. But I think when you break down exactly what it looks like under the hood at Supermicro, there are still some questions that need to be answered for investors.
Yeah, the company had been delisted before. Hindenburg had put this in their report. In 2018, the company had been delisted from NASDAQ for failing to file financial statements. You fast forward into what they had to work through in 2024. And here and now, as Luther Vandross would say, finally being able to file these results that ultimately revealed that revenues came in, or at least net sales for the most recent reporting period that they were publishing for, were at about $5.9 billion for the period, just shy of $6 billion for the period there.
All right, let's take a look at Lowe's. It's another mover that we are tracking here at Yahoo Finance. Lowe's topping fourth quarter expectations. Same-store sales are rising for the first time in just about 2 years. Still, though, the home improvement retailer's outlook coming up just a bit short. They talk about some of the uncertainty that they face in the near term. Now, this is a bit similar to some of the sentiment that we heard from rival Home Depot earlier this week. You are, though, looking at gains of just about 4.5%. So the fact that same-store sales growth did turn positive, it's helping some of that sentiment there on the street. Lowe's annual guidance slightly trailing consensus expectations, and this was similar to what we heard from some of the reaction to Home Depot as well. Much of the street is looking at that guidance as being conservative, so they think that they are going to be able to beat it. There was a couple of analyst notes out there calling it prudent as well. So similar to Home Depot, similar to what we heard from Walmart, maybe there is this thought out there from the street, this confidence that they are going to be able to exceed some of that weaker than expected guidance, and that, of course, will be adding a bit of a lift here this morning.
Yeah, three things that were called out within this report: pro and online comparable sales, strong holiday performance, and then some of the rebuilding efforts in the wake of recent hurricanes. However, what was offsetting all of what they categorized as some of the areas of strength in the quarter, continued near-term pressure in DIY, do-it-yourself discretionary spending. That is something that we also heard from Home Depot here. And so going forward, as we're thinking about what these results mean, even though they were better than expected, as Marvin Ellison, CEO and chairman and president of Lowe's, had said within this release, they are continuing to gain some traction with this total home strategic initiative that they had unveiled to the street. And ultimately, it seems like they're pretty confident in the strategy, capitalizing on some of the expected recovery that they're anticipating to come forward here. You're looking at a comparison here, extended hours of how Home Depot and Lowe's are doing. Lowe's, of course, moving higher on those fresh results. Home Depot, even though we did see a little bit of a different reaction yesterday, perhaps bouncing back just a little from their results. Finally here, let's talk Lemonade. Lemonade falling today after missing fourth quarter revenue estimates. The online insurance company also issuing weaker than expected guidance for 2025, expecting to take a hit from losses related to the California wildfires. Joining us now, we've got Daniel Schreiber, who is the Lemonade CEO. Daniel, always a pleasure to grab some time with you here, and thanks so much for joining us. Walk us through these results and how you're looking at 2025.
Absolutely. And it's interesting that you framed it as a miss on Q4. I think it's been taken as a comfortable exceed on Q4 by just about everybody. We'll talk about guidance in a second, but this was by far and away and by any measure pretty much the best quarter for the company ever. So fifth consecutive quarter of accelerating growth. We saw 2x or 100% growth in our gross profit year on year. Our expense line remained flat pretty much, or even negative in real terms. So we saw tremendous AI efficiencies kicking in, all of which resulted in $48 million of positive free cash flow, which came in. We weren't expecting 2024 to be cash flow positive. We were expecting that to be next year. It came in about a year ahead of time. So I think top line, expense lines, gross profit, bottom line cash flow, everything came in ahead of our own expectations, let alone the streets. Guiding for 2025, we think we're going to do exactly what we have continuously said, which is continue to see acceleration in 2025 towards 30-something% next year. So we guided to continued acceleration. We guided to consecutive EBITDA improvement towards EBITDA break even and profitability towards the end of next year. So from our perspective, this is entirely in line with what we've said we were going to do all along. So we're feeling pretty good, excellent about the results, and pretty good about the path ahead.
Daniel, when it comes to the California wildfires, and they was discussed a couple of times here on the earnings call that you just wrapped up earlier this morning, I'm curious what that overhang looks like for your business.
Yeah, so obviously the California wildfires were devastating for the communities in Los Angeles, and that includes many, many of our customers. We saw approximately or approaching 1,000 of our customers suffer during the fires. So we've been very busy tending to their claims as best we can. And turns out that the best we can is pretty good. We were able to settle hundreds of claims within the hour of them being submitted, oftentimes while the fires were still raging. We monitor customer satisfaction pretty closely, and at a delicate and sensitive and difficult time like these fires, being there for customers, reassuring them that even if their home has gone, at least the insurance company is going to pay up in full and instantly is hugely important. And if you look at the customer satisfaction scores, the CSAT out of 5, we scored 4.98 with a 91% NPS, which is really off the chart. So we've certainly stood the test of were we there for our customers. In terms of the financial impact, there were estimates that Lemonade would have to pay out as much as $200 million just looking at our market share. In fact, we are going to be incurring something like $45 million of gross losses. And because we have pretty sophisticated and conservative reinsurance structures, the ultimate impact on our EBITDA this year and in Q1 will be as modest as $20 million. So our people, our systems, and our financial structures were all tested by these devastating cataclysmic events. And I think they were all true to the moment.
Daniel, how much of that increased efficiency that you were talking about is driven specifically by AI? And if so, then how much more investment maybe are you thinking about allocating to that to further improve your business?
It's overwhelmingly about AI. We saw 100% growth in our revenue over the course of the last couple of years with 10% decline in our headcount. So we're doing a lot more, servicing many, many more customers, selling more products in more geographies, and doing it with fewer people. We're not doing it with less intelligence at work. We're doing it just with less human intelligence at work. And each of our customer support agents and each of our claims agents and each of our engineering programmers, et cetera, they are all managing to output far, far more than once they could. Almost all our policies are sold entirely by AI, something like 98% without human intervention. And that is also true of the majority of our claims, which are settled without a human ever needing to be in the loop. So you crush costs through the use of AI while delighting consumers who get instant everything without any kind of nonsense that they associate with insurance typically. We think there's a lot still to be done. As LLMs and other models continue to progress, the challenges that once, and when I say once, 6 months ago seemed insurmountable to them, are becoming easy for LLMs to handle. You can start moving from app interfaces to email interfaces, SMS, and we've already started showing some of the voice interfaces that we're doing. So we think that trend has a lot of legs and will run for quite a while.
Daniel Schreiber, CEO of Lemonade, thanks so much for taking the time to join us.
Good to be with you.
Let's take a look at Instacart under pressure after reporting mixed fourth quarter results, issuing a weaker than expected outlook for the first quarter. That's weighing on shares today with the stock off just about 10% ahead of the open. We'll be right back.
Taking a live look at the opening bell at the NASDAQ, where Control Group is ringing the opening bell. Music make you lose control. And they got some funfetti on the right side. And on the left side of your screen, you've got NYSE's shot of the New York City Department of Veterans Services ringing the opening bell to kick off today's trading activity. Let's take a look at where we begin. The Dow Jones Industrial Average opens up flat, but to the upside here, 0.2% fractional gains here on the day out of the gate. S&P 500, you're seeing that up fractionally as well by about 0.3% here. I want to populate this chart for you just so you could see how things are moving on this hump day, coming off of some of the other activity that we've seen to start off this week here. And you can see some slippage over the past 3 sessions here for the S&P 500. We'll see if we can dig out of that here and now. And taking a look at the NASDAQ Composite, that begins things today higher by about 0.4%. Let me populate this chart for you as well. If it will cooperate, we will be able to show you the past 4 days, and we are. It's down by about 4.3% for the tech-heavy NASDAQ. We're going to dig into XLK for a hot second here as we take a look at the S&P 500 sector activity out at the gate this morning. We've got more gainers than laggards here, but as I mentioned, XLK, that is leading the pack. That's up by about 0.9% here. And lastly, taking a look at the NASDAQ 100, you've got Nvidia leading the pack, going ahead of its earnings that are coming later today. Opens up the day by about 3.5% to the upside. Let's get to Yahoo Finance's Jared Blickery for a deeper dive at what's looking here early in today's tape. Hey, Jared.
Thank you, Brad. Well, I want to start off with the S&P, actually the Russell 2000. The Russell 2000 has been acting pretty weak. It just closed at the lowest price since September. I'll put a 6-month chart here so you can see there, it just barely undercut these lows. And if you're squinting, you can kind of see a head and shoulders top here. So definitely want to get back above this line here. Let's call it 2180. And we want to see that in ideally today or the next day. So that Russell 2000 looking a little bit weak there. S&P 500 has been weak this week, as Brad was just going at, but the S&P 500 equal weight has been surging, and so it's a different chart. You take a look at the S&P 500 equal weight this year, much stronger. So what we've been seeing is this bifurcation in the market where tech, and especially large tech, has had some bumps this year and in the month of February, and that's what we're dealing with here. And the big question for traders is, how does the bull market stay alive? Do we have enough rotation in some of the other sectors to keep everything buoyed? And so far we have, but we're in danger with several of the indices, several of the sectors undercutting some big technical levels. Here's a 10-year T-note yield. So it just touched the lowest since December, but it's not doing anything right now. It's a big flat, so we'll keep an eye on that, but not doing too much today. And I want to skip over to the sector action. As we close the month of February, I've been noticing, and I'm going to put a 1-month trailing chart here, so that'll get a few days in January, but this illustrates the point. Consumer staples, that's the stuff that we need. That is up 7%. That is leading this month, and that's a defensive sector, so that's not necessarily bullish. Consumer discretionary, the stuff we want, that is leading, but to the downside. So that's Tesla, that's Amazon. Both of those have been faltering recently, and Tesla has been hurting this year. So let's take a look at what's going on today. Just one more time, tech leading, staples lagging. So a little bit of a reversal from fortune from the beginning of the week. And we'll switch over to the NASDAQ. And I wanted to take briefly a look at Tesla, which is having a rough go at it this month and this year. As I was stating, it's actually the worst month for Tesla since January of last year. Here's a year-to-date chart. You can see it's shed about 1/4 of its value there. And from here, we're going to finish with the futures market. A few interesting things happened yesterday. We saw some big declines in a bunch of different markets. Crude oil and gold have caught my eye. Now, gold has been rallying fast and furious towards 3,000. Never quite got there, but it has fallen back to 2,900. In case you're worried about the long-term trend, it is still intact there. So gold bugs still have that 3,000 in sights in potentially the near future. We'll have to see how that plays out. And finally, WTI crude futures. Those had a big down day yesterday. And last I checked, they were holding about $68, $69 per barrel. See if we can get a quote there. There we go, 68.89. So crude oil, another market we're watching, and see if that stays under pressure. But with all the inflation talk, with all the inflation gauges heading higher, one has to wonder when it reverses to the upside. Shana.
All right, we're going to talk to Ines in a little bit more about that. All right, Jared, thanks so much. So now for today's strategy session, retail investors' favorite trade has come under a bit of pressure with the Mag 7 cohort officially entering correction territory. But investors who have actively managed their portfolios to move out of tech stocks have actually outperformed the S&P 500. You can see it up there on your screen. Joining us now, we want to bring in Angelo Krokafis. He is Edward Jones, a senior investment strategist. Angelo, when you take a look at the underperformance here of the Mag 7, so those investors, I guess, that have favored actively managed funds have been able to maybe avoid some of those losses. But I think the big question for investors right now is whether or not the trends that we've seen since the start of the year, are they going to continue, or if they are going to reverse on the heels of what we hear tonight? What do you think?
Yeah, I think the broadening of market leadership that we have seen, and it is encouraging for those with well-diversified portfolios, has some legs to that. There is a potential for that to continue. And I think it speaks to the resilience of the market that even with the Magnificent Seven lagging the S&P, we still have a market that is up for the year. And we thought all along that earnings will have to do the heavy lifting, not valuations, and that so far is proving to be the case. Investors can diversify and actually find areas that have this catch-up potential, even without relying only on the AI trade, which is still an important one.
So if we are seeing that diversification take place, that would also suggest perhaps that more than just a sell-off, this is a great perhaps rotation that we're seeing play out. Where's that rotation into from what you're evaluating?
Yeah, so it's rotation at multiple levels. It's been across sectors, investment styles, thinking about value versus growth, and also geographic. Europe is hitting European equities, all-time highs. Asian and Chinese equities are participating as well. So thinking about the policy mix, there is some uncertainty with tariffs, there is some excitement about tax cuts. And when you put everything together, we still think that US equity markets are well positioned in terms of some of the domestic cyclical areas can stand to benefit from these tax cuts, while growth, yes, it is modestly slowing, but remains pretty robust in the US.
How worried are you about the slowing US growth in the US and ultimately the cap that could put on equities this year?
Yeah, I think it might be a first half, second half situation where we do experience a soft patch in the first half. We did see some weakness in retail sales. The PMIs for services activity have been a little weak, and the economic surprise index is back to negative territory for the first time since May of last year. So all that suggests that we could see a seasonally weak first quarter, and that has been a pattern over the last couple of years, but then a reacceleration later on. The fact that we are slowing from a strong starting point is not as worrisome as even 2% growth for the standard of an advanced and very large US economy that can still provide a solid foundation for corporate profits to continue to rise. And that's what we've seen.
Wasn't it just yesterday that the Fed Vice Chair for Supervision, Michael Barr, was saying that the growth for the economy still relies on policy stability, and maybe I'm getting that mixed up, maybe the policy relying on economic stability, but you have things that could throw off that economic stability right now, both in the form of employment and inflation driven from any tariff impacts as well.
Yeah, no doubt there is a lot of sensitivity to what's going to happen on the inflation front. Some upside risks, no doubt. So far, we have seen some rise in inflation expectations, and that's what the Federal Reserve pays close attention to. But at the same time, they're comfortable keeping rates where they are. There's no urgency for them to cut. And looking at the labor market, it remains pretty steady. We've seen 21 months of continued wage gains exceeding the rate of inflation, and productivity has been rising, and that's a positive story. We can still have robust wage growth without refueling inflation, especially for services. This is, which is what is the category that's still pretty elevated.
And so how are you looking at the outperformance that we've seen overseas, particularly in Europe, and maybe what that tells us?
Yeah, it is encouraging, the fact that many people have left European equities for dead. Whenever the pendulum is swinging too far one way, it kind of self-corrects, and that's the phase we are in now. There is some hopes of Russia-Ukraine peace agreement, which could result in low energy prices. Still too early to make that call, but the fact that European and some of the other international markets were so discounted, that provided this release valve as a lot of pessimism was baked in. That said, over the last 10 years, we've seen several counter-trend rallies. So it might be a little premature to say that this is the beginning of something larger. But for those investors that have been way too underweight international equities, it's a good reminder that they deserve a spot in portfolios, especially as we deal with very different scenarios on how things can play out on the trade front. If things are not as onerous or aggressive as feared, that can be a catalyst, a trigger for a continued rally, but too early to make that call.
It's a great reminder. Angelo, thanks so much for taking the time here today, just after the market open.
Thank you.
Appreciate it. It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at Nvidia and where the street expects shares to head. Maddie.
That's right, Brad. Nvidia price targets from analysts on Wall Street starting to outpace the performance of the stock. So let's take a look at this. Analysts continue to boost Nvidia's price target, and now the best price targets, the highest price targets on the street, are significantly outpacing the performance of the actual stock by the biggest difference since earlier this year. And you can see here this divergence really starting up following the $600 billion sell-off we saw in Nvidia's stock after DeepSeek poured out this idea that they were able to train their AI for cheaper. Now, what's really interesting about this is, of course, as a potential shareholder, you want to own the stock at a time when the stock is potentially outpacing those analyst price targets. But one of my favorite sources to talk to about this, Steve Zhao over at Bloomberg Intelligence, basically did his PhD in analyst price targets and taught me a lot about it. And he has said that over time, analysts tend to be correct. So yes, right now, analyst price targets are a little bit above Nvidia's share price, meaning that they could be wrong. They could be overly bullish on the stock. But if you look at the totality of analyst price targets on stocks over time, they do tend to be right. So that could be one potential indicator that Nvidia's stock price could be hitting these analyst best target prices over time. Of course, tonight's earnings will give us a great indication of that. We will all be monitoring any news to come from the man in the leather jacket later today.
We certainly will. All right, Maddie, thanks so much. As we head to break, let's head to check on shares of TJX, the company behind TJ Maxx, Marshalls, and Home Goods. Easily beat Wall Street expectations for its holiday quarter, but it issues guidance that came in just below the street's expectations. It looks like the street, though, very much focused on the fact that it did surpass when it comes to some of those sales estimates there for the street. Again, enough to look at gains here in early trading. You look at the stock up just over 1%. We'll be right back. Bitcoin trading right above 86,000, remaining below 90,000 mark for the second day in a row. Now, when it comes to the most recent declines, we're seeing Bitcoin trade at levels that we haven't seen since November. When you take a look at that pullback that we've seen over the last couple of trading days. Now, this follows the rally that we saw following the inauguration of President Donald Trump. Also, some of the excitement following his election back in November, which sent the prices to record highs. Here with more on what we could expect going forward, we want to bring in Scott Melker. He's the host of the Wolf of All Streets podcast. Scott, it's great to have you back here on Yahoo Finance. So help us make sense of some of that selling action that we have seen in Bitcoin most recently.
Well, I think that there are a few catalysts for the selling. First, obviously, as you mentioned, we overshot probably the high end on hype around Trump hitting a high of around 109,000. I think the market is now absorbing most of that and finding a mean reversion of sorts. But I think there's a few catalysts that have been sending price down at the moment. Obviously, there's just macro fears in general of tariffs, of instability. Markets hate uncertainty, and I think we're seeing that to some degree with Bitcoin and the crypto market as a whole. We had the Bybit hack of roughly $1.5 billion in Ethereum by the Lazarus Group in North Korea. I think most of Wall Street and institutional investors didn't know about that until they woke up on Monday. That's probably contributed to the sell-off. And then, of course, the absolute meme coin madness with Trump launching a coin and then the Libra token debacle in Argentina. We've just had some short-term catalysts for downside that I think will be relatively quickly absorbed, and then we can get back to the bull market that we're used to.
To what extent do you believe that there is still trust that needs to be reinstilled coming off of some of the other meme coin events that have taken place, even from the voice that said that they were going to be the pro-crypto president and that we've got a Bitcoin strategic reserve that's going to be prioritized day one?
Well, you have to remember that those things were effectively priced in as promises. So now you need to see Trump and his team deliver on them. And I think that largely we have. There's just really high expectations. We have a pro-Bitcoiner in almost every cabinet position that exists in the White House. We have pro-Bitcoiners at the SEC, CFTC, literally across the board. So those promises are being made. And we do have legislation on the books for that strategic Bitcoin reserve. I think the meme coin craze will be forgotten. I think it's also important to remember Libra, technically not even a meme coin at all, literally just a pump and dump by a government or the leader of a government, but it was promising specific utility to help businesses in Argentina. Very different than meme coins, which are literally described as having no utility as collectibles. But I don't think that there's a huge amount of trust that needs to be gained back. I think those things, as I said, will just disappear into the ether. They're just a nonsensical sideshow to the game. Everybody understands now that Bitcoin itself and crypto are here to stay. They're serious institutional assets. When you have Citadel talking about coming in to become a market maker, I think that a few meme coins will be forgotten.
Scott, when it comes to certainly, obviously, the street, Wall Street and Main Street very much showing more interest within crypto, I'm curious, when you take a look just at the fact that volatility swings, and you can obviously make this argument for many investment vehicles out there, but what does that do? Does that at all, do you think, keep some investors on the sideline, just given how rapid of a run-up we had following the election, peaking right around the inauguration? Now we've been selling off just a bit. I guess, how should investors then be looking at when is the right opportunity to buy?
I don't think that investors should be trying to time the market or find the right opportunity because, as you said, it is volatile. That may keep some people on the sidelines, but I think that that number is drastically reduced. And listen, I mean, volatility is the price of admission for exponential gains in Bitcoin, and it's not really that different if you buy at 86 or you buy at 80 or you buy at 75 if you believe it's going into the multiple hundred thousands or millions with time. The best strategy is to go full Michael Saylor and dollar cost average slowly into Bitcoin when you have money that you're willing to invest and not touch for a long time. So I would urge people not to really be concerned with whether the price is 86 or 82 or 90, because long term that will effectively be a nothing burger. I mean, I would argue that Bitcoin hasn't crashed. It's on sale. And we know that smart money buys the blood, even if it's their own. And that's what's happening right now. You can see that there's some retail exiting, but institutions are gobbling up Bitcoin at an unprecedented pace.
Scott, thank you. We're continuing to track all the moves here this morning. Appreciate it.
Thank you.
Before we head to break, let's take a look at shares of General Motors. GM raising its quarterly dividend by 25%. The company also announcing $6 billion in stock buybacks. Shares higher by 7% right now. British oil giant BP announcing it's pivoting its focus back to its core oil and gas business while lowering spending on renewables. Here with the story, we've got Yahoo Finance senior markets reporter Ines Ferre. Ines, what do we know here?
So I spoke to CFO Kate Thompson this morning, and three of the main points that the company wants to make is one, reallocating investments, going more towards oil and gas and less towards renewables, reducing costs, and also a big divestment plan. So this move to double down on oil and gas was widely anticipated by the street. Just to take a step back in 2020, BP was the first of the big oil companies to pledge net zero emissions by 2050. It set targets to cut oil and gas production while increasing renewable energy output by 2030. But that strategy really has come under increasing criticism from activist investors that have been really voicing their concerns that the renewable investments were destroying shareholder value. You had Elliott Management that entered the scene recently, amassing reportedly some 5% stake in the company. And with this move, now investments in renewables will be reduced by 70%. But some of their green businesses may be receiving partners. So on the divestment side of the business, Castor Oil, that's their lubricant business, which has been also involved in coolants for data centers. That's up for strategic review. They're also talking about perhaps a partner for Light Source, its solar units. But I do want to make one note that the rate of buybacks has been cut to anywhere between $750 million to $1 billion. That's a sizable cut, more than what analysts had been expecting. That's perhaps why you also may be seeing the stock down a bit today, because it has gotten sort of lost in, or it may take some attention away from some of the other announcements.
Yeah, and Ines, this pivot that we're seeing from some of these companies, of course, coming at a time when we've seen crude under a bit of pressure. You have WTI, I believe, trading in the high 60s at this point. I'm curious what you're hearing about this steady move that we've seen to the downside.
Yeah, so as far as the steady move to the downside, look, they are going to be increasing production. And the production also has gotten now, for all of these companies, has gotten a lot more efficient. So the cost of producing oil, of drilling, has gotten much, much better. So even the break-even point, you've had some analysts that have been talking about the break-even point going lower because of these more efficient ways of producing. But for BP, this is going back to their roots. This is going back to something that they know how to do very well. The question is whether this will appease those activist investors, all these moves that have been taken. But they're saying, look, we think that given all together, that in the coming weeks, when they talk to their long-term shareholders, that they are going to be pleasantly surprised as they see everything come together, everything packaged together. Today, it's just been a lot to digest.
More broadly here on oil, I mean, you have decisions from OPEC, and OPEC putting more pressure internationally on continents like Africa to increase production here. So what is kind of the lay of the land on oil more broadly as we're looking at some of both the supply inputs and where the governing bodies are also trying to figure out it makes sense?
Yeah, so, and OPEC has been sort of tied at the hands with respect to their market share, because they really want to increase market share, but they understand that there is the risk of oversupply. And all the analysts that we've spoken to have forecast that prices will be lower this year compared to last year, and going into 2026 even lower. So we'll have to see how that shakes out with what OPEC decides to do, how OPEC, if they're able to regain any market share, because look, everyone wants to drill now. Everybody is going in on the drilling. US is going big time on the drilling, but OPEC really wants to be able to increase market share, but the prices are trending lower.
All right, Ines, thanks so much. Well, that does it for Morning Brief. But keep it right here. We've got Catalysts coming up next, much more analysis on some of the biggest drivers of today's market action. We'll be right back. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, we'll break down today's market action as the S&P 500 rebounds from those 4 days of declines. Where can investors find safety?
Plus, we push ahead to the all-important earnings after the bell as we await Nvidia results. We've got full coverage for you ahead.
And we hone in on Washington amid Doge's efforts to cut federal spending. What could that mean for tax season? We'll discuss with the former commissioner of the IRS.
About 30 minutes into the U.S. trading day, you are seeing a bit of a recovery playing out following 4 down days for the S&P 500. We certainly saw risk-off sentiment creeping into the market following some of that weakening econ data that we have been getting out, particularly on the sentiment side of things over the last several trading sessions. Now, ahead of Nvidia's results after the bell tonight, we are seeing some buying action. You do have the S&P up just about 0.6%, the NASDAQ leading the way, up just about 0.9%. And Maddie, when you take a look at the gains that we're seeing in the NASDAQ today, I think that's obviously going to be a focus, just given one of the things that I know that you've been watching, this lost momentum out of the momentum trade, and whether or not Nvidia results are going to be enough to help regain some of that lost confidence that we have seen.
Especially given that DeepSeek sell-off we keep talking about that led to a $600 billion loss in Nvidia's market cap. I think this is interesting, a chart I'm looking at on the terminal right now showing that mega cap U.S. tech stocks are the most under-owned when you take a look at active investors, but it seems like they just can't shake this trend of going back to their tech X here, because every time we get a little bit of a sell-off, you then see a day like today. 4 days of selling, we're making such a big deal out of it, but in the context of the market, that's really just not that big of a deal.
Yeah, that's true. Well, we're not used to it.
Right.
Because we're used to so much optimism being in the market. We're used to some of these, I would say just optimism across the board. And now we are starting to see maybe the markets take a different view more broadly of the U.S. economy, be a little bit more critical about some of the reports that we have gotten out, which hasn't necessarily been the trend over the last several months.
Yeah, and we certainly are at a minimum seeing a shift in the market underway. When you take a look at factor trading, seeing investors move from the momentum trade into areas like value. So could Nvidia results change or cement the rotation? Joining us now with more, we've got Jeff Crumpleman, Mariner Wealth Advisors Chief Investment Strategist and Head of Equities. Jeff, great to chat with you. Talk to me about the momentum trade sort of stalling out as investors shift over from growth to value. How cemented is that trade in your view?
I don't think it's extremely cemented. And I think also for context, it's interesting when you say that the mega cap tech stocks are the most underowned. You have to keep in mind that they now represent some of those holdings in the S&P 500, which has become so uber concentrated. They represent 7, 8, 9% position sizes. And so, back when I started in this industry 40 years ago, if a single holding in a diversified portfolio was in excess of 5%, you were considered reckless. So they're still heavily owned and they represent more than a third of the S&P 500. I think it's probably smart to underown them relative to the index. That's part of active management. But to answer your question, we have noticed that if you look at what is working so far this year, because of all of the violent pace of news flow, whether it's tariffs or deportation strategies or government shutdown or whatever it is, it's spooking people. And if you look at the charts, it's healthcare, staples, these defensive areas that you're seeing rotation into and that are outperforming. And after lagging for some time, I think that could be sustainable, but I think it's premature. We are ever so gingerly taking the foot off the pedal just a little bit and recognizing that some of these defensive stocks represent very good value. And you might want to nibble just a little bit.
Jeff, I guess for investors that are trying to figure out whether or not that some of the buying action that we have seen in those that have underperformed the more defensive plays, whether or not there's more room to run within that sector. I guess more specifically, what are you looking at in order to determine that we could see more broadening and we could see more activity within, is it a continuation almost of some of that weaker econ data that we have started to see?
Well, it's a combination of the top down and the bottom up. The bottom up's going to be there. I'm not just going to make some kind of shift into the defensives cause. The earnings have to be there. Valuation certainly is there. And I think that if we continue to see strength and breakouts in some of these weaker names technically, that gets your attention. And then as you see flows start to develop in those areas, that's saying sentiment, has kind of shifted. So I think we just got to see a sustained period. And you're right. I mean, tonight is data. If Nvidia comes out and the earnings news kind of reinstills confidence, then, I think that we will see a more balanced, broader participation this year. We expect the market to be up 10%, and both camps could do well. I think it just depends on what the news flow is out of areas like Nvidia and the Mag 7. As long as the news is not devastating, they can still do well. And as long as the economy holds up and earnings in these other areas, they're very attractively priced. And I think you could just see a broadening in the market with some of these other stocks playing catch up. But it's a day-to-day kind of observation on what's going on.
So you mentioned your price target of 6,600 by year end, implying about a 10% move. And I hear you saying that there is still a bit of optimism to be squeezed out of the tech trade. But what gets us that 10% move to the upside? Again, you're saying this broadening, but you still like tech. What exactly does that 10% move to the upside look like? And how do you position to take advantage of that?
Well, first of all, it's a function of PE multiples and earnings, right? That's how you get to 6,600. So if you apply a 21.5 multiple to our expected earnings that you'll see as we move into 26 of a little north of 300, that's how you get 6,600. And then you have to go underneath the hood and see, well, how are you getting that earnings growth? And quite frankly, right now, consensus earnings, when you look broadly across sectors, not just technology, but it's healthcare, consumer discretionary, finance, earnings growth looks good. So, you can argue about positioning, but when you just look at the aggregate index level, there's earnings support there. And it's predicated on about 2.5% earnings growth. The 10-year Treasury trading around 4.5%. And solid margins that hold up. And right now, there's no reason to think that that's not going to happen. And we may get wiggy day to day about the recent headlines on news coming out of the administration or speculation about what the Fed may do. But underneath the hood, you've got solid earnings growth broadly. And that's what you got to continue to track and see if we stay on course. And there is risk when you're trading at 21, 22 times. If profit margins stall, then you're going to get some hiccups. But right now, that's how you get to 6,600.
All right, Jeff, we have to leave it there. Jeff, we have to leave it there. Thanks so much for taking the time to join us here this morning. I want to get to some trending tickers at Yahoo Finance. Scan the QR code below to track the best and worst performing stocks of the session. That's the Yahoo Finance's trending tickers page. There's a slew of auto news out today, from Lucid to GM to Stellantis, plus to some overhang here, potential tariffs that continue to loom across the industry. Here to cover it all is our very own Pras Subramanian. And Pras, we were discussing where to start just because there's so many headlines driving a lot of the action here today. But let's stick with Lucid, just given some of the activity that we are seeing in the stock here so early. Shares falling as the company launches a search for a new permanent CEO. And this comes following the unexpected departure of its long-term CEO, Peter Rawlinson. When it comes to some of the concern that's maybe playing out within the industry, I guess, what are investors most concerned about when it comes to the new potential CEO?
A big mix here, right? So last night we got the news that Rawlinson was stepping down. I was pretty surprised, and no one saw that sort of coming. He was there for 12 years, sort of brought the company to where it is today. I think the issue potentially maybe for investors and the big investor, which is the Saudi PIF, was that maybe they the company wasn't cutting costs enough as it drove growth, and it's sort of launching its new Gravity SUV. But we'll have to see. Rawlinson is going to stick around as a strategic technical advisor to the chair. The current COO, Mark Winterhoff, is going to be the new interim CEO for the time being while they do their search. But yeah, it seems like Rawlinson sort of brought the company to where it is, but the next level, the next phase, the ownership management probably wanted a more efficient operator there to kind of get the company back into, or get the company into the green at some point, or at least have a path for that. One bright spot is that they do see deliveries doubling this year to 20,000 vehicles because that new SUV that's coming out in the next few months.
Well, Praz, it's also a share buyback season, and we have some news from GM with shares moving to the upside as it's looking to boost its quarterly dividend, and also has some news of share buybacks and a repurchasing plan. What can you tell us?
Yeah, you know, GM a few weeks ago disappointed investors by not announcing a buyback plan or a capital return plan, but now they have decided to do so a few weeks later. They're going to get basically a hike in the dividend of 3 cents per quarter, so up to 15, I believe. But more importantly, it's that $6 billion share repurchase plan that includes a $2 billion ASR or accelerated share purchase plan that happens right away, and the balance of which can happen over time, then that $4 billion. But regardless, GM shares are getting a popular, investors getting that capital they want returned back to them. We'll see how that plays out. CFO Paul Jacobson said that they would prudently manage their situation and announce these buybacks. And last year, you had a huge run up in the stock because of these share purchase plans.
And also, Stellantis shares are sliding after issuing guidance that fell short of analyst expectations. And this comes after, as you know, they had a tough year last year and said they do expect to return to revenue growth and positive cash flow this year. What else can you tell us?
You know, last year, Stellantis said that they saw 2024 being a potential turbulent year. I don't think they had any idea of how bad it would be. They lost their CEO. They saw sales sort of crater in the U.S., ballooning inventories. That sort of leads to where we are today. Full year revenue down 17% from a year ago. Full year profit down 70% from a year ago to 5.5 billion euros or 5.8 billion US dollars, well below analyst estimates. They do see a return to revenue growth next year. They had deeply negative industrial cash flow. They see that returning to the positive, but it's going to be slow steps, small steps for them to kind of to recreate what they had in 2023, which is a blowout year. It's kind of surprising to many people to see how they lost that momentum so much into last year, whereas GM and Ford doing better than they are, but still, we're talking about an industry that's sort of in the focus here with Trump talking about tariffs. A lot of these guys are trying to prepare themselves for how do I fulfill my supplier commitments? How do I get my parts, my cars back and forth across the Mexican-Canadian border? That's another big overhang for all these three companies right now.
You know, President, I want to talk to you a little bit more about tariffs because President Trump posted on Truth Social this morning very critical of something that was published by the Journal, and he basically said that he views tariffs, that they're going to be a big win for the industry. He said, quote, just let it all happen. Obviously, that contradicts some of the research and some of the modeling coming out from analysts just in terms of the impact that this could have on especially the big three automakers, and then ultimately maybe some of the costs that could be passed on to consumers as a result.
Yeah, I think Trump is not only reacting to criticism on the left, but criticism on the right. This is the Wall Street Journal editorial page saying that these tariffs are just a bad idea. I think he's just sort of frustrated with those comments because he wants them to be on board with this policy, which is sort of a continuation from his previous term. But as you know, as we talk about, a lot of these companies, especially the auto companies, are interconnected with suppliers and assembly plants that are across borders. This is a big problem for them, and I think Trump is trying to address the criticism on both sides to get his, at least his side on his economic policy projections here. But that is a big problem right now for the auto companies and a number of other multinational companies, is that the fact that they have to somehow navigate a world where tariffs can happen at any time. And right now, it's just like sort of there's a sort of Damocles hanging over these companies. When is it going to hit? He's saying, let it all happen. What does that even mean? So that's where we are right now with these big companies.
All right, Praz, thanks so much for joining us and breaking down all the news in the auto sector for us today. Appreciate it.
Thank you.
Next up, AB InBev shares jumping on better than expected revenue in its fourth quarter, offsetting a decline in volumes. Here to explain, we've got our very own Brooke DePalma. And Brooke, it's so interesting because that global sales volume was significantly down, but then we see a move to the upside. What's the takeaway from AB InBev's earnings?
Right, well, investors certainly saying a toast this morning because we did see a beat on both the top and bottom line. But taking a closer look, revenue growth really was driven by a few key factors. When I spoke to the CFO of the company this morning on a phone call, he said that growth, that 2.7% increase in total revenue to $14.84 billion was largely driven by the execution of their strategy as well as volume growth in keyword most of their markets. So that strategy that they're really pursuing here is focusing on this idea, this concept of mega brands, so focusing in on roughly 5 brands per market, and that's what drove more than half of total revenue this past quarter. Now, if you take a closer look at volume, we did see a decline of 1.9% year over year in the quarter. Now, that did move lower by 2 key markets. You had mid to high teen negative volume growth in both Argentina as well as China. In China specifically, the CFO alluded that to the softer consumer environment in China, saying that they specifically saw softness within their on-premise occasions like those night outs. Now, if you also take a closer look at what we saw here in the U.S., a bit of good news there. We did see sales to retailers, a key metric that many on the street watch, return to growth. That increased 0.05% after we saw a decline of 12% in that same quarter last year. When I asked how exactly is the U.S. consumer holding up in this environment, the CFO said that the U.S. consumer is in okay shape. He alluded to this dynamic environment in 2024, a colder summer, and then a colder weather to kick off the year. He also said to really get a fair take and a fair understanding of where the U.S. consumer is, we'll be looking to the summer.
Yeah, and Brooke, we just had a graphic up there talking about tariffs, and I think that is a real focus here for investors as they try to figure out what company is maybe best positioned to be able to look beyond, or I guess weather some of the turmoil that could come.
Yeah, we're hearing a lot of that from one of their closest competitors, Constellation Brands. There's lots of fear on the street that because of Mexican imports potentially being impacted by tariffs, Constellation Brands will lose in this. But Anheuser-Busch saying that's not the case. It's a global beer company, and they really look to beer as a local business. Specifically, the CFO did say most of our beer is sourced, brewed, and consumed locally. So any exposure to tariffs is very limited. Specifically about the U.S., 99% of what we sell in the U.S., we make in the U.S. He went on to say that we source the vast majority of our ingredients and other raw materials also in the U.S., so there would be a very limited, if any, impact. Now, I did go on to ask, what about aluminum prices? We know that that's been top of mind. He said that once again, they're more or less in the same range than what they saw last year, and that they have a hedging policy. They're really hedging against this, but once again, emphasizing that tariffs, if they do go into effect, would be a very limited impact on the Anheuser-Busch company.
All right, shares up just about 8.5%. Brooke, thanks. Well, we got much more of your market action ahead. Stay tuned. You're watching Catalysts.
The big day, Nvidia earnings after the bell. You can see the shares up nearly 3.5% after fighting a couple of weeks of losses. Year to date, the stock is down nearly 6%, and this comes as those Nvidia earnings expectations are sky high. Some big questions heading into the report are supply and demand dynamics. Will the company have the supply to meet the demand? That is something that the other big tech names struggled with, particularly Microsoft. Of course, another big question, what are we seeing in terms of transitioning from the Hopper to the Blackwell chip, and then anything that's said about that competition from DeepSeek, we will be monitoring in our special coverage on Nvidia earnings after the bell. But let's broaden this out to what this means for AI data centers. Meta is reportedly in talks to build a new $200 billion AI-focused data center, according to the information. That report comes days after Apple pledged to invest $500 billion in the U.S. over the next 4 years. Part of that will be used to build out AI infrastructure. Here with his read on data center build out, we've got Anthony Johnson, CEO of Clayco. It's a construction firm specializing in data center construction with clients including Google, Microsoft, and Amazon Web Services. Thank you so much for being here with us, Anthony. I just want to kind of operationalize the demand picture from where you sit. We hear about these big dollar investments from the hyperscalers. What is that looking like right now across your desk, and how much growth have you seen in that demand?
Yeah, thank you. Good morning, and it's a pleasure to be here today. It's just truly an incredibly exciting time in the industry. For one, it's almost like we're part of a modern day space rush or gold rush. And what we've been seeing over the last several years, even prior to the AI push, has been, number one, an extreme growth in cloud computing. You think about the computing required for everything from iPhone usage to companies converting everything to cloud storage. There was already a strong foundation of growth in the data center market. AI has added another layer of exponential growth that we've seen over the last couple of years. And that's resulted in the need for more computing power, more dense builds, which require higher levels of energy and higher levels of mechanical cooling as well. So a lot of new innovation and drive that's happening in the business right now.
Anthony, I'm curious, just given the learnings, the findings that we did hear about just about a month ago when it comes to DeepSeek, has that at all changed? Have you seen at all just a shift from some of the commentary or priorities here from some of your customers?
You know, not really. I think in any business, as the technology evolves and as more competition is introduced, there's innovation. And innovation is good. Competition is good. And so I think there's new learnings that happen from one entity to another. I think Jensen Hughes did a great job of explaining the various levels of training and inference that are ultimately developed. And DeepSeek was a great introduction and new innovation in the business, but there still is a tremendous amount of training beyond DeepSeek's capabilities that are needed to truly get to a strong inference solution.
I also want to talk about another headwind presented by TD Cowen this week. Analysts saying in a note that in their channel checks, they have evidence that there are data center lease cancellations happening from Microsoft, of course, one of your clients. Have you seen any of that cancellation from Microsoft on data center buildouts?
You know, not speaking to Microsoft directly, but just speaking about any large business that's undergoing a large CapEx expansion, I think growth is something that is not exactly linear. There are strategies that are implemented. They're modified over time, but in the end, the growth trajectory is still maintained. So we don't really see day-to-day changes in one facility or another affecting an overall outcome or an overall capital spend. In fact, to the contrary, we continue to see extremely strong demand in the market from various users in the space.
Anthony, what's the ability there to meet that demand?
Well, that's where I think, as I spoke earlier, this type of demand and growth drives a lot of innovation to the space. We've innovated ourselves and developed a solution that we've branded as Clayco Compute. And when you look at how these facilities have traditionally been delivered throughout the United States, there's been end user ownership. There's been partnerships with good engineering companies. There's been partnership with great construction companies, but there hasn't really been a one-stop solution. And Clayco Compute, which we launched earlier this year, really brings that engineering capability, the procurement capability, construction, and also self-perform all under one roof for a single source solution for our customers. Speed to market is key. And to not have to bring multiple parties to the table, but rather be able to call one partner to be able to deliver that full integrated solution is what we're doing to differentiate ourselves and really address our customers' biggest need, which is how to get them to the market the fastest.
Yeah, and I guess the good news for you is that your customers continue to ramp up their AI spend, despite what the market might think about that. If we can pull up, we've got a chart indicating just the sheer record-breaking numbers in terms of CapEx from the big tech names here. You've got on your screen Meta expected to spend about $65 billion, and then all the way at the longer end, Amazon expected to spend about $100 billion in AI CapEx, and CapEx in general, rather, in 2025. But that leads to a question and concern about whether the froth is already there. You were able to double your data center revenue from 2023 to 2024. It seems like you're growing, but at a slower clip now. What would you say is driving the deceleration?
I wouldn't say there's any deceleration. Actually, it's really a controlled growth phase for us. Construction's a business to where, our reputation's everything. And we have to make sure that every project that we deliver is on time, it's under budget, it's delivered safely. And so when projects of this size and scale are being executed, it's important that, we dive through our resources, make sure that we've got the right leaders on the project, that we've got the right resources allocated to certain projects. So certainly no constraints in the market that are holding us back from growing at all. I would say, to the contrary, we're really trying to self-moderate our growth to some extent so that we can ensure that we're continuing to deliver at the high level of excellence that our customers demand.
All right, Anthony, great to have you. Great insight. Thanks so much for taking the time.
Yeah, thank you.
Coming up, we'll hear from Intuit's CFO. He will join us live to discuss the company's second quarter results and what proposed changes under the Trump administration could ultimately mean for the industry. We've got that coming up next on Catalysts. Intuit is surging today following the fact that the company beat expectations for its fiscal second quarter, also reaffirmed its full year outlook. Morgan Stanley upgrading the stock from equal weight to overweight following those results. We want to bring in Sandeep Aujla. He's the CFO of Intuit. And Sandeep, it's great to have you here on Yahoo Finance. So it's a pretty impressive reaction that we're seeing in shares today. We're looking at the biggest intraday jump that we've seen since at least 2021. Talk to us just about the factors going into that improved guidance and what you really see as sustaining some of that momentum clearly that you're seeing within your business.
Well, good morning. Thank you for having me. I couldn't be more proud of the work the team did. We've got excellent momentum across the company executing on our global AI-driven expert platform strategy. The momentum we have across Intuit Assist, our done-for-you experiences with expertise embedded. The momentum we have in mid-market, where we're gaining ground day in, day out, and getting better at executing on that strategy. And finally, a strong start to the tax season. The results we had the first half of the year are positioning us really well to continue to build on this momentum and have a strong year, strong fiscal 2025. And the results in terms of 19% revenue growth overall for the company, and in our 17% overall for the company, 19% of Global Business Solutions Group, our largest business, as well as 21% in online ecosystem, which is a business that is at an $8 billion annualized run rate. Just exceptional execution across the company by the team.
And Sandeep, talk to me about how you're utilizing AI on the platform to drive revenue, because you offer some of that as sort of a given with the fees that are charged to customers for filing via TurboTax. But what parts of agentic AI are you utilizing to drive even more revenue on top of that original fee?
The way we look at AI, it is a core part of the product experience across our platform. So we are taking end-to-end tasks. We're taking entire functions and automating those. In the consumer group, in the tax business, from the moment you land on our website and we get to learn about you in terms of what your profile is, what your tax situation is, we use AI to serve up the right offerings for you. So every person who comes in is not going to see the same lineup. The lineup is using AI to deliver a very bespoke experience. And then once you get into the experience, we now have 90% coverage through 200 partners to bring in the data versus 68% coverage last year. And we now know in 90% on what your tax situation is. And based on that, it's going to be a very bespoke experience for you, Maddie, versus for me. And that is AI operating at scale in the consumer business. And some customers may not want to do their taxes themselves, and they may want to use one of our 12,000 AI-powered human experts. And in those situations, we are using AI to match the right expert to that customer and give the customer the profile why we think this is the right expert for them. Mm-hmm. And there we see 82% conversion rate of people taking that expert up. And then we're using all the data to power the expert so they're able to do a tax return in as little as 2 hours. And when we get the tax return done, the customers are giving us an 84 product recommendation score, which is amongst the highest in the company, if not one of the highest across the broader software industry. So across the board, AI is just a core part of how we work, and it's really paying off at scale.
Yeah, that's a huge uptick rate in terms of what you're saying, 80% of users utilizing that AI expert to walk them through their tax filing. Have you all had conversations about charging extra for that expert?
When customers engage with an expert, that is a higher priced offering compared to when they do it themselves. But beyond our consumer group, when you look at our small business, our Global Business Solutions Group, where we serve small and mid-sized businesses, what we're seeing is when we're taking unstructured data and turning that into invoices, or turning that into payment reminders, or turning them into automated books done for you experiences, and customers are then using that to remind their end customers to get paid. We're seeing 10% higher payment conversion rate. We are seeing customers take up our agents on the Global Business Solutions Group as well, and we shared that their QuickBooks Live offering, where a customer works with an agent, is up 2.5 times year over year in terms of number of customers we're being served. So these offerings where you're working with an agent come with an order of magnitude higher ARPC than our do-it-yourself offerings.
So Sandeep, I'm curious how you're looking at the developments out of Washington, the cuts that are expected and that we're seeing here at the IRS, obviously ahead of the critical tax season, ultimately the impact that could have on your business.
As a company that serves 100 million customers, we engage with the Washington and the administration, regardless of which political party is in power. And our goal with the engagement is always to serve our customers, to make sure that the government policies, the regulations are for the best benefit of the consumers, as well as the entrepreneurs who own the small and mid-sized businesses we serve. So in that area, I think our engagement has been quite positive. The changes being made at the IRS right now, we think will not have a negative a negative impact on the business. In fact, likely a positive impact. What the government is focused on is driving efficiency. They're focused on taking out fraud, and they're focused on making sure that the end customer is having the best tax filing experience and the clarity in terms of what their tax situation is. That's very much in sync with what our goal is also as a company. So I think this is going to be more of a tailwind to us than a headwind.
Sandeep, help me understand that a little bit more. How would that have a positive impact, especially in the context of something that I've been noticing, which is this idea that's going around social media of people not filing their taxes because the president floated an idea of the federal income tax going away? So how do these cuts at the IRS provide a tailwind for the business?
The cuts at the IRS, Maddie, are focused more on the contractors and not the core part of the IRS. Where I mentioned the tailwind and how that becomes relevant to our business is that the DOGE, as well as the administration overall, is focused on taking out fraud through the tax code. They're focused on clarifying the tax code so that the end customer understands how the taxes apply to them. And those are very much in sync with what has been our focus over the years. So that's where I mean it being a tailwind as opposed to a headwind.
All right, Sandeep, we always appreciate you making time for Yahoo Finance, so thanks so much. Again, Intuit stock soaring on the back of those results. As we head to break, we're going to check in on shares of Zoom Info. The company seeing shares jump by the most in 5 years, up 17% on the day. Our own executive editor sat down with the company's CEO following those results. Let's take a listen.
2 quarters ago, I personally bought $13 million of the stock. Last quarter, I bought another $5 million of the stock. Like, I believe in the same thing that the company believes in, is that the price of the stock is undervalued. And as long as it is, there's a great return to be made by buying the ZoomInfo stock. And, you know, I tell investors that I really believe in the future of the company. I know that we're hitting an inflection point where the company is going to really start accelerating.
The IRS is cutting over 6,000 jobs in the middle of tax season as part of a downsizing effort from the Department of Government Efficiency. Several IRS commissioners under Republican and Democratic administrations came together in an op-ed for the New York Times, calling the job cuts, quote, a huge mistake. Joining us now, one of the people behind that op-ed, Daniel Werfel, former commissioner for the IRS from 2023 to 2025. Daniel, great to speak with you here. I just want to kind of level set from you off the top because you were so recently in the IRS. What is your single biggest concern right now about the future of the IRS?
Well, I start with the layoffs, and myself and the other commissioners were confused by this decision, because if the goal is cost efficiency, I think one of the first things you learn on the first day of business school is the bottom line of an organization is made up of both cost and revenue. And the IRS is the accounts receivable department for the US government. And so by depleting the capacity of the accounts receivable of the US government, you deplete the capacity to collect revenue, and you'll actually reduce cost efficiency. So the commissioners got together and really wanted to point out this disconnect between the goal of efficiency and then taking an axe to the accounts receivable of the organization you're trying to make more efficient.
Daniel, what about the ability here for the IRS to even process tax returns, to issue refunds promptly? Is that something that they're capable of doing given the magnitude of the cuts?
Well, this is a concern. And all the commissioners, when we spoke about these layoffs, we all reflected on the fact that one thing you don't want to do during filing season is destabilize the organization. You don't want to increase risk. You want things steady as she goes. And a layoff of this magnitude is going to be highly disruptive. Even if you try to tailor the layoffs more towards collections than taxpayer service and processing, even still, the stress levels that this creates, and also the fact is that as much as you try to avoid laying off people involved in services, there still will inevitably be implications, and we could see delays in processing, delays in people getting their refunds timely. So this is just something that if you're going to make a big move with the IRS, first of all, we wouldn't cut the IRS because that will reduce cost efficiency of the government. But if you're going to make a big move, wait till after the filing season.
Daniel, I'm curious just to get your perspective on this. Given the magnitude of the cuts, there obviously has been a confidence problem when it comes to the American public and their trust in the IRS. After a cut like this, does that actually exacerbate some of the issues that we have seen creep in?
I think there needs to be more education about what the IRS is and is not. Look, the IRS does not do a popular function. Collecting taxes is never going to win you a popularity award. But it is an absolute essential function that someone needs to do. And you know who's doing it? Moms, dads, community volunteers, Little League coaches, people of faith. And the other misconception about the IRS is we're all in DC wearing suits. The reality is that 98% of the IRS workforce works outside of Washington, D.C., in cities, suburban areas, and small towns all across America. And these people just come to work. They're not trying to win a popularity contest. They're doing the job. And here's another misconception. Cutting the IRS does not cut your taxes. Only Congress can decide what the tax rate is. Cutting the IRS just means that the government will be less effective in collecting the taxes that are already owed. You know what? It's the equivalent of a CEO basically saying, we sold a lot of goods and services this year, but let's deplete accounts receivable and make it harder for us to collect the proceeds of those sales. Mm-hmm. I think the shareholders, the boards of directors would be upset with that decision. The only one that would cheer a decision like that is likely the company's competitors.
Well, and it's interesting in the context of everybody is obviously worried about the deficit, right? And every single organization has inefficiencies that could be cut. But as a former IRS commissioner, where do you see the line between efficiencies and cuts that could undermine tax enforcement?
Yeah, the last thing I want to do is defend the status quo. I've always been a change agent along with a lot of the IRS commissioners that I work with the op-ed on. And we always said we don't have the monopoly on the right ideas, and we always welcome new input. And there is certainly too much waste and error in government. That said, there's been a lot of progress over the years in reducing waste and error. And there's a lot of smart people in the government today that have been working and have saved billions of dollars for taxpayers. Our suggestion is to work with these people, collaborate with them, build on their successes, and provide new input and new ideas on how to accelerate and improve the reduction of things like improper payments or waste in government. But what you don't want to do is undermine the ability of the US government to collect revenue. And the IRS collects virtually all the receipts, $5 trillion a year, that go to the essential functions like air traffic control, food safety, defending the homeland, arming our military. All of that is made possible by the very unpopular thing of tax collections. We should preserve the IRS's ability to collect those taxes and certainly make it more efficient. But laying off thousands of IRS workers in the middle of filing season is not the way to do it.
Daniel Warfel, we thank you so much for taking the time to join us here on a very important issue. Former Commissioner of the IRS. Thanks so much, Daniel.
My pleasure.
As we head to break, let's take a check on shares of App11. Two short sellers releasing reports on App11, which was 2024's best performing tech stock. Now App11, which provides marketing services to app developers, actually falling to the lowest level that we've seen since November amid its worst intraday drop since 2022. The report's effectively alleging that App11 misrepresents the benefits of its AI advertising platform and instead, quote, force feeds app installations onto phones as a way to drive up revenue. The stock was briefly halted for volatility in today's trading session. You are looking at losses right now, just about 14%. We'll be right back.
Ahead of Nvidia's fourth quarter earnings report, shares of Nvidia and ETFs tied to its performance are higher. But our next guest says there's a broader shift away from U.S. equities in favor of assets like gold and international stocks. So could Nvidia's earnings print be enough to bring enthusiasm back to U.S. large caps? We've got Aniket Lal, CFRA Research Head of ETF Data and Analytics, for this week's ETF report brought to you by Invesco QQQ. Aniket, great to speak with you here. Talk to me about the flows you're seeing heading into Nvidia earnings and what they can tell us about what we might expect today.
Flows have actually been fairly strong into ETFs this year. We've seen, over $130 billion so far this year into ETFs. A lot of that actually into equity ETFs. So flows have been good into tech. We know historically, though, that flows do tend to lag performance. And as far as performance goes, in the last few weeks, particularly since tariffs were first announced, we've seen non-US equity ETFs outperform US equity ETFs. As you know, this is a reversal from what we saw both in 2024 as well as the period post-election and pre-tariffs. So we've seen some change in sentiment and performance. Flows haven't quite caught up to that yet. Obviously, as you mentioned, Nvidia earnings is going to be big in terms of seeing how U.S. equities does going forward.
You know, Annika, that brings up the question, too, just of some of that other risk-off sentiment that has certainly creeped into the markets. And specifically, when you take a look at some of the selling action that we've seen in crypto recently with Bitcoin under a bit of pressure, maybe that hasn't yet been totally or completely reflected within the fund flows data. But I'm curious what you're seeing there and what you think sentiment looks like here as we do look ahead to a potential catalyst here from DC.
What we've seen with crypto as well as the ETFs that track spot crypto is there's really two factors that kind of influence it. One is, of course, regulation, and the second is rates. On regulation, the reason crypto has had such a strong run up in the last 12 to 18 months is really because we've seen a lot of positive news. We saw ETFs being launched in January of last year. That took in over $100 billion. You know, ETFs that track spot crypto now have $125 billion in assets. We, of course, saw the news that Chair Gensler, who's been a little bit more hawkish on crypto, kind of stepping aside, replaced by Paul Atkins. So all of that news, and of course, we've seen recently the SEC kind of dropping its case against Coinbase. And so all of these factors really been what's driven crypto up. So it's really been a regulatory sentiment-driven appreciation. Having said that, we also know that crypto tends to be very sensitive to rates, and the downturn currently is probably more a reaction to rates. We've seen crypto typically have a very kind of high correlation with tech. And so when rates go up or there's concern about inflation, that really impacts crypto. So it's really regulatory. The news has been positive, but recently I think that's been offset by concern about rates and inflation.
Yeah, and it's interesting, too, in the context of the outperformance we're seeing in European stocks year to date, particularly when compared with U.S. stocks. Talk to me about where you're seeing that rotation when it comes to ETF flows.
One thing interesting about European stocks and ex-US stocks, particularly in Europe, is that the sector composition tends to be very different from the sector composition in the U.S. As you know, in the U.S., we've got the Mag 7 and the tech stocks kind of having a huge weight, in the S&P 500. Whereas if you look in Europe, it's financials, it's consumer staples, it's sectors like that have actually dominate a lot of the indices. And we've seen strong results from stocks like Santander, HSBC, some of the healthcare stocks, and Novartis, and so on. And so we've seen actually since the tariffs were first announced in February, ETFs that track European stocks have actually, and developed market stocks outside North America, have actually outperformed US equities, largely on the back of better kind of results from financials, consumer staples, and healthcare.
All right, Annika, thanks so much for breaking that down for us. Let's do a quick check of the markets. Just about 90 minutes into the trading day, you are looking at some buying action here. The S&P looking at gains here following 4 straight days of declines. You got the Nasdaq up just over 1%, right around the highs of the session. The Dow adding 214. Of course, a move to the upside coming ahead of Nvidia results after the bell tonight. Very much the direction, maybe sentiment, more so the broader market could hinge on the results that we will be getting from the chip giant here in just a few hours. But again, all three in the major averages. As it stands right now, 90 minutes into the trading day, we are looking at gains. Coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith, he has you for the next hour. We'll see you tomorrow.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
It's time for Yahoo Finance's Market Minute. Stocks are rising. The NASDAQ leading gains as investors anticipate Nvidia's earnings. Super microcomputer shares soaring after submitting its delayed regulatory filings, meeting the NASDAQ's deadline to avoid delisting. Server makers' updated filings showed sales more than doubled in 2024 to nearly $15 billion. Home improvement retailers are looking to make a comeback. Lowe's shares ticking higher after reporting positive same-store sales growth for the first time in 2 years, boosted by a strong holiday season and increased building following hurricanes last fall. And General Motors shares are surging as the automaker looks to reward its shareholders. GM boosting its dividend to 15 cents a share and initiating a $6 billion share buyback program. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Check-In, we break down what to expect in Nvidia's earnings, whether you should buy the dip on Bitcoin, and why investors should trade on math, not emotions. Plus, TJX is out with quarterly results this morning, and a number of retailers are set to report next week as well. We discuss some retail stock picks to consider for your portfolio, plus getting retirement ready. All week long, we've been taking a look at how to invest for retirement at every single age, from workers in their 20s, maxing out that 401k match, to those over 70 living off of their investments. And today we focus on your early 60s, what that pre-retirement age and push that one expert says is actually still a great time to keep saving. All that and much more coming up during today's show. But first, let's begin as we always do, taking a look at some of the market action. We are 90 minutes into the trading day. Stocks right now, for the U.S. major averages, we're seeing gains across the board. The Dow up fractionally 0.5%, S&P 500 0.8% higher, and the Nasdaq up 1.2%. So rising today ahead of that big Nvidia earnings report due out after the close. The S&P 500 on track for its best gain in 5 sessions. Joining me now, we've got Vance Howard, who's the Howard Capital Management CEO and CIO. Vance, you say that investors should be trading on math right now and not emotion. Explain what you mean by that and how you're looking at the state of the market right now.
Well, you know, our proprietary indicator, the HCM byline, is an intermediate to longer term trend indicator, and you need to follow the trend. It's equally as important as the Fed, what the Fed does. And the HCM byline is positive, so we see that as any pullback as being viable. And I think there's a lot of great opportunities that have set up, and you look at, you know, Salesforce and some other areas, especially tech. So I think we're going to see the market start to bottom out, you know, sometime this week, and I think that's a very, very positive sign. But net, we're very bullish for 2025.
Now, when you say trading on investments and trading on, math, not emotion here, no animal spirits playing in and showing up in that, how can one go about aptly making sure that they're not being overly emotional in that investment decision?
Well, you know, I get calls all the time. I got a call the other day, and they were talking about, hey, should I sell my stocks because of what's going on? The market's pulled back 3 days in a row. And I'm like, 3 days in a row? That's a non-event. That's just movement. But the trend's clearly one thing that people need to pay the most attention to. And if the trend's up, just stick with the trade until the trend breaks. And right now, the trend's very, very positive. It's strong. And these pullbacks are actually gifts, I think. I think 2025 is going to be a wonderful year. You know, you're seeing Salesforce pullback, Amazon pullback. These are viable opportunities for investors.
And it certainly could play out wonderful trough to peak, at least, as long as we hit some of those targets that many of the big firms have set forth. It seems like the consensus is somewhere around S&P 500, 6,600 by year end. And so we have a ways to go until we get to that point.
Right.
But one of the major bellwethers that we've seen time after time again, earnings period after earnings period, has been Nvidia.
Yes.
How much of that is a make or break, at least in the early innings of 2025?
I think what it's going to do today is somewhat stabilize the market. I don't think you're going to see the market really shoot up higher. You know, you've got two different things. You've got the Russell 2000 and you've got the Mag 7 are now oversold. And now they were overbought, you know, a week and a half ago. So now you're sort of working off a little bit of that trough. One of the key areas that we've been looking at also is look at the QQQ. If it can get above that 540, that's a breakout. Now it's trading in that range, and always remember, never short a dull market. Up until the last 3 days, the past 6 to 8 weeks, it's been pretty dull. It's been just sort of sideways trading in a range. So I think there's opportunity here. Keep your emotions in check. Don't sell out just because you had 3 bad days, because 3 bad days, a week from now, they can make up for it in a heartbeat.
You know, what we've seen in the last few sessions here as well is pressure on some of the riskier areas of the markets. And crypto naturally comes to mind with that. How have you been evaluating it?
Well, you look at crypto as 110, and it's packed off to about 87 now, 87,000 now. I think it's going to go down to about 81 to 80. I think you've got support there. I think the overall market, NASDAQ tech, is very much viable. I'd be a little bit patient on crypto. Net, now listen to what I'm going to say. I think we're going to hit an all-time high in Bitcoin by the end of the year. I think we'll come out of this 110 and shoot back up. And even the drawdown that we're seeing now is less violent and less volatile than what we've seen historically. So it's starting to stabilize.
Any price target for that all-time high for crypto?
Don't have an all-time high. I'm just predicting it'll break out of that 110. I think people will be very, very pleased. And this at 80, even if you bought it today and it pulls back a little bit further, I think you've come in at a good entry price.
I want to end the conversation where we began, and that was some of the picks that you had. And you had mentioned Salesforce, I believe, within that here. Why is that? And is that perhaps indicative of a broadening in the AI trade?
I think so. And you know, one thing that I like, and you and I have talked about this before on your show, is I love recurring revenue. Salesforce CRM's a symbol. They have recurring revenue. They don't have to go out and resell the product every month. They get a check every month for somebody that's using it. Plus, you've got AI that can be infused into Salesforce, which can actually make a real big impact and make the product more valuable and more usable for investors and for people who are using it to advance their businesses.
Really interesting. Vance, great to have you back here in studio with us. Really appreciate the time and the insights here.
Thank you so much.
Absolutely. Now time for some of today's trending tickers that we're tracking for you. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's talk about TJX, rising after topping estimates in the fourth quarter. Comp sales rising 5% from the prior year, beating estimates there. The retailer is seeing strong sales in each of its divisions, including TJX Canada and International. The CEO, Ernie Herrmann, says that the company opened its 5,000th store last year and sees many opportunities to grow the business in the future. The upbeat results overshadowing, though, some soft guidance. We will break that down a little bit further in a moment. Next, Kava posting disappointing sales guidance. The company sees comp sales between 6 and 8% with the midpoint trailing analyst estimates. Adjusted EBITDA guidance for the full year fell short of expectations. Analysts mostly bullish after the results here. TD Cowen pleased with the fourth quarter sales strength. William Blair highlighting the 5th straight quarter of increasing foot traffic. And Barclays says that momentum has sustained contrary to the industry. And finally here, we got to check in on Lowe's. That is rising after topping fourth quarter expectations, with some of the same store sales rising for the first time in about 2 years. High single-digit sales growth in its pro business and online segments, plus strong holiday performance and rebuilding efforts, as they call it, in the wake of recent hurricanes also boosted the overall sales. Still, the home improvement retailer's outlook came up a little short as it faces near-term uncertainty. This echoes similar sentiment that we heard from rival Home Depot. Well, Lowe's acknowledging the home improvement market remains challenging in the company's fourth quarter earnings call. Home Depot reaffirming that outlook, acknowledging ongoing pressure on large remodeling projects, attributing soft home improvement demand to macro uncertainty and higher interest rate environments. Here to discuss how the industry will look moving forward into 2025, we've got Bill Darcy, who is the global president and CEO of the National Kitchen and Bath Association here. Just want to get your read through some of the earnings reports for the biggest home improvement retailers here in the U.S.
Yeah, great. Thank you for having me on and representing our 55,000 NKBA members. We're here in Las Vegas at Design and Construction Week. So it's interesting that timing that, talking with you, because there's so much energy here. And I think what you're hearing from the big box retailers is the macroeconomics, what we're expecting this year, about 0.8% growth. So that's really because DIY, multifamilies, DIY mostly is bringing the market down a little bit. If you look at single family, mid to high income, though, we're looking at 4% growth. So I think that's probably indicative of some of the enthusiasm we're seeing here at KBIS in Las Vegas.
And so all of that in mind, how are you thinking about the renovation market, especially for some of those DIYers, as we know that consumers right now, they're pressed for which projects they can prioritize and the costs associated?
Yeah, obviously we have our skilled labor challenges and some consumer uncertainty, and that's been the stagnation we've seen. I think we do see optimism this year and people coming off the sidelines where they're getting a little more comfortable with those, the mortgage rates as well. But really remodeling is still the driver. I think people want to stay in their homes. They want to invest in their homes. And even if they can't purchase a new home or move, this is where they're going to spend the money. So I do think, on the lower end of the market where the DIYers start in the big box stores, potentially going to see still more hesitancy because of the instability in the market. But definitely at the luxury side and the single family higher income side, we're definitely seeing a lot of growth potential.
I wonder what you're hearing from the pro side of these businesses, the contractors, those who are working on construction and trying to make sure that they are sourcing correctly to meet the demand that they're seeing as well.
Yeah, interesting. We have like over 2,000 brands here at KBIS and Design and Construction Week with the International Builder Show as well. And I think that's what they're desiring, sourcing products. Where can they be creative? We have an interesting membership because it's their creativity. I mean, these folks are making beautiful spaces. So they're very resilient, they're very creative, and they work around challenges. And I think they love to source new products. So yes, you will see some shifts in there. I think, the consumers want to maximize their budget with the best products they have and the more intelligence that the pro will have in knowing the best products and services that are available to the consumer, I think makes them more valuable, and trying to get these projects done within budget.
To the extent that it's making its way through the conversations at the conference, how is and what is the pulse check on tariffs and the impact on some of these larger projects?
Yeah, it's interesting because coming into the event, certainly this seems to be topical, the biggest top of mind. And I was a little concerned, like, what are we going to say? We have to really, it's too early to tell. I mean, that's the truth of it. However, you would never know that on the show floor. The optimism is so strong And I do think people believe these things will settle down. I think this is disruptive. I mean, we have immigration tied in and all this, things that it's hard to understand even for the average contractor consumer. But it's surprisingly mild or non-existent, I would say.
All right. Well, if you see a stress ball tchotchke on the floor, make sure you send one my way, Bill. Just lastly, while we have you here.
Absolutely. Yes.
Lastly, while we have you here, as we are thinking about the broader mortgage rate environment and how that impacts everything that we've been talking about, to the potential for new home build outs, for the potential for remodeling projects as well, as many are spending further in, as they're not going to be, for some of them, moving anytime soon, especially if they're sitting on a good mortgage rate and don't feel like they need to refinance at all. How closely are you tracking what's taking place within the mortgage rate dynamic as it passes through to some of the biggest contractors and suppliers?
We were, the magic number we felt was 5%. Many of the mortgages, in the market are well below 5%. And then that's really what's sometimes driving that remodeling versus moving. I mean, no one's going to move from a 2% mortgage to a plus 5%. But I think we feel consumers are getting a little more comfortable with that 5% and not going to stay on the sidelines forever. But we are tracking this very closely. I'm actually going to, we're going to see what the Fed's going to do. And I don't know that they're going to be very aggressive, is what we're feeling this year. But despite that, I think as the consumers feel more and more comfortable with 5% and really their desire to really stay in their homes, this really does drive remodeling. So yes, we feel for the construction side and the new construction side and new home side, but we really feel that that even higher interest rate sometimes is the driver for further remodeling.
Bill, thanks so much for taking the time here.
My pleasure.
I'll be looking out for that stress ball.
Absolutely. See you soon. Thanks again.
Coming up, everyone, why investors are increasingly drawn to alternative assets. That is next on Wealth. A report from Preqin estimates that by 2028, the total alternative assets under management could grow to over $24 billion. That's up from $16 trillion. Let's talk about this again. $24 trillion, up from just $16 trillion 2 years ago. Joining me now in studio to break down why alternatives are growing in popularity is Dave Donahue, who is the Franklin Templeton head of U.S. Wealth Management Alternatives. Dave, great to speak with you here. Let's just break down that figure in itself here. $24 trillion is what we're talking about. It could potentially grow to. What is going to be the leading driver of that?
Yeah, it's a great question, Brad. And first off, terrific to be with you today. Three big drivers are moving this forward, right? It's really a sun, moon, and stars aligned scenario. On one side, the investment case for alternatives has never been stronger, and that's paired with technology innovation and really what I view as a product manufacturing revolution. So let's break that down. On the investment side, take public stocks for an example. If you look back 20 years, we have roughly half the companies in the US publicly traded that we did 2 decades ago. Another way to view that, companies in the US that generate over $100 million in revenue, somewhere between 10 to 15% of them are publicly traded. So people are realizing if you're not investing in alternatives, which may no longer be an alternative, you're missing out on the growth of the economy and the full opportunity set. That trend holds in real estate, and it holds in private credit as well. So that's the demand side that is moving, in particular, individual investors to the alternative market. That demand is spurring innovation to satisfy demand. From technology, making access easier and broader, and from manufacturers creating new product that's created for the wealth space, making it easier for them to adopt these types of solutions.
We were talking in the break about all the new different types of alternative assets that have emerged here. What asset classes, though, are you seeing the most interest from those who are looking to add this into their portfolio?
2 areas really stand out to us. One is in private equity, a subset of it called secondary private equity. That's where you invest into a primary private equity fund, taking someone else's position in that exposure, often at a discount. And we're seeing growth there in wealth in particular, because it allows folks who historically haven't had exposure to get that exposure quicker in a high quality and diversified way. The other area, which may be a bit controversial, is real estate.
Interesting. Why is that controversial at this point?
Well, I think people read the headlines and they see what's going on notably in office. And we have had on the equity side of real estate a period of the last couple of years of corrections. But if you look at certain parts of the equity real estate market, namely multifamily apartments or industrial, think data centers, think warehouses for e-commerce, the fundamentals are really strong. And because pricing has come down over 2 years, you're seeing a ton of interest. But interestingly, Brad, on the debt side of real estate, that's where we see probably the longest runway of growth for the next decade. It's following a path that private credit followed post the global financial crisis, and history doesn't always match identically, but it often rhymes.
Certainly.
And we see real estate debt about to go through a super cycle of growth, like you're seeing private credit experience over the last decade.
If you are adding alternative assets to your portfolio, what should your ideal time horizon look like? And I know this is going to be different based on the type of asset that you're adding in.
It's a great question, because this is what scares folks off if they don't fully understand that. They think alternatives are inherently illiquid and they're locked up forever. The first thing I would say is it's important to understand your unique situation. What's right for you? Work with an advisor or work with a trusted partner. Generally speaking, you're not going to allocate a majority of your portfolio to alternatives. Institutions, for instance, average about 30%. The wealth investor is somewhere closer to 3% today. So that number needs to come up, and it will come up. But we don't know that it ever gets to the 30% institutions have. The way I would think about it is in a 5, 10, or 20% of your portfolio, allocating to things like private equity, private real estate, private credit can enhance returns, increase diversification, help with yield or tax efficiency, depending on the asset class. But you want to be mindful that that pool of capital isn't something you're going to touch every day. In fact, I saw one of your earlier segments and you said, follow the math, don't follow the emotions. Private markets allow you to follow the math because they price off fundamentals with less frequency, but they aren't going to have the same volatility of the public markets that are moving based on market sentiment.
We got about 30 seconds left here. As we're trying to make sure that the maths, if you will, what should be the kind of general rule of thumb? And again, different across asset types, but the type of returns you should be looking for in these emerging asset classes or alternative assets?
It's going to vary by asset class, to your point. But generally speaking, there's a long studied concept of an illiquidity premium, both academically and in kind of real life. And that illiquidity premium says if you take a portion of your money and you're willing to lock it up and be patient with it for a longer period of time, you can, in private equity, potentially increase your returns, in private credit, potentially increase your income. And it's important to understand how these pair with your total portfolio, right? So it's not a standalone decision, but how do I integrate and integrate the right way?
Dave, great to see you here in studio. Thanks so much for joining us.
Thanks for having me, Brad.
Absolutely. Coming up, everyone, what retail stocks should you add to your portfolio and which should you avoid? I talked to a retail strategist and analyst about that next on Wealth. TJX full year same store sales growth forecast came in weaker than expected, making it the latest retailer along with Walmart and Home Depot to express caution in its forecast for the year ahead. Retail earnings roll on next week too. We'll get results from the likes of Target, Abercrombie & Fitch, Foot Locker as well, and more. Here to discuss is Stacy Widlitz, SW Retail Advisors President. Stacy, great to have you here with us. So first, want to get your reaction to TJX's earnings this morning.
Very strong mid-single digit comp numbers here. And really what you need to focus on is transactions are up. This is not a ticket story. This is a traffic story. This is a story where the consumer is getting, hit every way with inflation, yet incredible treasure hunt and value, one of our very long-term top picks, and continue to like the stock here. Yes, like Walmart, TJX was a little bit conservative on their guidance. I mean, this is quite normal for Walmart and TJX to approach a new year conservatively, particularly since there's so many moving parts in our economy right now, and with the administration, with tariffs and what ifs. So I think it's more about just being conservative. than actually what's going on right now. Walmart has said their consumer is very steady right now.
And so those are some of the themes that could certainly kind of transpire through some of the other big names in retail. I want to run through some of your takes on some of those big names. Abercrombie & Fitch, for instance, that's off to a rough start this year after rising nearly 70% in 2024. How are you evaluating the growth and how that translates into the share price appreciation from here?
Yes, we've seen a group of brands come out on the other side of COVID and really keep full price selling intact. And investors have looked at this group of stocks, Ralph Lauren, Tapestry, Abercrombie, and said, is it sustainable, or are they going to go back to discounting someday? Tapestry and Ralph Lauren have shown us, yes, overwhelmingly, this is sustainable. Both of them had double-digit average selling prices up last quarter, and the consumer was out there buying. Abercrombie, that's reporting next week, they've shown a couple promotions on the Abercrombie brand in the last couple months. So that's a big question mark here. And the stock has traded off significantly because we've seen some of those promotions hit the market that would suggest maybe their full price selling is not as intact as other brands.
Next here, as we're talking about some of the brands, let's talk about Nike. Big turnaround plan underway here, new CEO at the helm. So how are you looking through this brand and your assessment there?
Yeah, I think, Nike, first of all, has a ton of newness in the market right now in footwear, which is great. But I think also, Nike has cut back. They have kind of alienated some of their core runners. They're trying to get that back. It's a big ship, and it's going to be a big task to turn it. You've seen on running, you've seen Hoka take nice share from Nike, and they may be able to get it back, but I think right now I'm still conservative on the stock. We've been negative on the stock for close to a year and a half, and I would say that there's still some flags in the market. The percentage of apparel on discount is up year over year. Footwear is like, there are green shoots in footwear, absolutely, but I'm still a wait and see on that one.
You mentioned Hoka. Let's talk about their parent company, Deckers here. So how is the market share gains there sustainable in terms of the growth that we've seen come forward for the brand?
I think it is. You've got the Uggs brand, obviously, which has accelerated over the past year and has been performing incredibly well. And of course, you have Hoka, which has been growing heavy double digits for years. And investors have been looking at the stock saying, again, when is it going to slow down? Can this last? And yes, their numbers did decelerate a bit this quarter, and their guide was somewhat conservative, but they have new launches in the market that are being received incredibly well. And I think that brand absolutely has staying power and will continue to grow here and will continue to take share. So, the stock has come down nicely on some very conservative guidance. So I would take a look absolutely at that stock. You've got two incredibly powerful brands that continue to perform and continue to launch new drops that are being received very well.
Well, let's talk about a company that hopes all of the newness is positive, and that's Foot Locker. They report earnings next Wednesday. Is this a stock you like?
No, again, we're avoiding Foot Locker. And if you think about it, Foot Locker is over 60% exposed to Nike. So if you want to play Nike, play Nike. Foot Locker is obviously the middleman. And again, they've had a lot of apparel on discount. It's been up year over year. They are benefiting a little bit this month from some of the new drops, which is great. But I think there are better places to look for investing at this point.
Lastly here, while we have you, we got to talk about the name that is within a 10-mile radius of 90% of America, and that's Walmart. Their latest guidance came in a bit conservative. Do you see headwinds ahead for the company, especially as they have several different aisles and categories that they're trying to maintain across for consumers' mind share?
Walmart's numbers were very strong. They did a 4 comp on top of over a 4 comp last year. The traffic is still positive and the ticket is positive. And you have to think about this environment, again, inflation. It's not transitory. It's not going away. It's actually reaccelerating a bit in food. If you think about it, they are the best positioned in the market to go back to their vendors and say, give us a break. We want to pass it on to the customer. We're not raising prices. And they win at that. Also don't forget they were positive in every category, even general merchandise, even though there was some deflation there. And of course, they have all these other higher operating margin revenue streams like advertising and marketplace that are just getting started. And finally, they are not the old Walmart. They are the new Walmart, where the higher income consumer is the majority of their comp growth, because those customers are now looking for value, whether it's food or health and wellness, and they are gaining that share. And I think that is not going to change anytime soon. So I'm a huge fan of Walmart here.
Yeah, Walmart CFO John David Rainey has joined us on the program before, talking about those higher end consumers trading in to Walmart. Stacey, thanks so much for your evaluation, this roundup of retail that we've been able to run through. Appreciate it. Nvidia is reporting fourth quarter results after the bell today. It's been the hottest stock on Wall Street for years now, up over 450% in 2 years. But as of Tuesday's close, the stock is trading 17% below its 52-week high. It's actually down so far in 2025. So, how are financial advisors talking to their clients about Wall Street's AI darling? I think I'm going to go check in with Decoding Retirement host Bob Powell and see how he's talking about this one. I heard he's in the building. Let's go see him. How are financial advisors talking to their clients about Nvidia right now?
So they're talking to them in two ways. One is to say, don't bet the ranch on an individual stock, even though it's a darling. Think about diversification. So for instance, you already own maybe a S&P 500 ETF, which has a 6% allocation to the S&P 500. So you already own Nvidia, right? And so if you think about it, the tenets of prudent asset management would be to say, you need to be diversified, right? And by owning an individual stock, what you're doing is creating unsystematic risk in your portfolio.
So what place does Nvidia have in your portfolio then?
Well, I think I would take a step back and think, what place does it have? And the first thing I would say is, what are you trying to accomplish with it? So if you're saving for retirement, you have a long-term time horizon. And perhaps, again, as I mentioned, you already own some of it. And if what you want to do is to take a portion of the money that you can afford to lose, mad money, maybe put a 1 or 2% into Nvidia as a long-term bet. Likewise, if you're in retirement, I like to think about it in two ways, Brad. One is you want a floor of income that will fund your desired standard of living, your essential expenses, and then you need upside for 20 or 30 years to protect yourself against the risk of inflation. And in that case, Nvidia might make sense as a long-term bet to help you the upside portion of your portfolio. Okay. I say all this with two things in mind. One is think about the risk that you're bearing for the return that you're getting. So go to Yahoo Finance. They have a number of tools that you can use to assess what's the risk-adjusted return of Nvidia, and that's really the key thing that you want to think about. And the other is risk tolerance, or I like to say, think more about risk capacity, which is how much money can you afford to lose, and what's the dollar amount, or what's the percentage decline that you can afford to lose. And so when you're thinking about investing in Nvidia, whether you're planning for or living in retirement, think about that.
When you talk about unsystematic risk, what do investors need to know about that risk that surrounds any name, but especially a name that is as popular and as long a trade as Nvidia?
Yeah, I mean, when I think about unsystematic risk, it's risk that you can't diversify away, right? It's unto itself with that company. So it's going to go up and down depending on the fortunes of that company. And the thing about Nvidia is, if you lived through the 60s, you witnessed things like Polaroid and Xerox, which were darlings and are no longer. Or even more recently, you witnessed darlings like Intel, and maybe not so much anymore given the allure of Nvidia. So I think you need to think about it pragmatically and to say, look, it may have its time in the sun, but I need to sort of protect myself. After all, what is it that you're trying to do, right? You're trying to build wealth in order to fund a lifestyle. And at some point, you can't put that lifestyle at risk.
And so when you think about names that have been as popular as Nvidia in the past in the stock market, and what that has done for people's planning. How many of them say, okay, I need to have this as a component within my retirement portfolio, but it can't be all of it. Where else is that diversification happening?
Well, I think it comes in a couple ways. One is to have, broad exposure to the markets. Maybe it's the S&P 500. Maybe it's a mid-cap index. Maybe it's a small-cap index. Maybe it's a growth index or a value index. And then maybe it's by sector. So maybe you're in the defense sector or the consumer goods sector or things like that, right? You need to sort of think about it as how a prudent portfolio manager would manage their portfolio for the benefit of, the people that they manage the money for. You are, you're not a gambler, right? You're not a speculator. So what you're trying to do is just be thoughtful about how you manage your money, and you don't want to take risks that you can't afford to take.
Are there key things that those who are saving for retirement should listen for in earnings calls like that from Nvidia that give them a sense of how the company is bearing up to what their timeline to retirement looks like?
Yeah, I think that's a great question. Again, I would go back to Yahoo Finance's investors tools and sort of, do the basic analysis that a fundamental analysis would do if you were a portfolio manager at Fidelity or Vanguard or T. Rowe Price or Schwab. You would be looking at their earnings relative to the past. You'd be looking at their future earnings. You'd be looking at their earnings relative to their competitors. And you'd be getting a sense of what's the long-term prospect for me to make money in this particular stock.
Absolutely. Bob, thanks so much for breaking this down. We're going to be watching closely to see how the market reacts to these earnings and how those saving for retirement or in retirement are able to really glean some insights about this name, which has certainly been a bellwether for the stock market. Appreciate the time, Bob.
Thank you, Brad.
House Republicans passing a budget bill backed by President Trump that calls for $4.5 trillion in tax breaks and $2 trillion in spending cuts. But critics are concerned the plan could put Medicaid at risk. Yahoo Finance's Jordan Weissman is here now with more on what the bill means for health care. Jordan, what do we know?
So the key thing to know about this bill is that it does not say outright that Republicans are going to cut Medicaid. And that's something Republicans have been emphasizing. It does not say, oh, these are the specific cuts. Instead, what it does is it calls for at least $880 billion worth of cuts over 10 years from the committee that oversees Medicaid, right? So it's basically saying that as they go through this legislative process to pass Trump's agenda, they're expecting a lot of these savings to come from Medicaid. They're just not saying exactly what they're doing yet. And if you do see those kinds of cuts, I think most experts are accurately predicting, pretty much devastation for a lot of state Medicaid programs.
And so with that in mind, what is the total potential impact of this? And you mentioned that it's over a certain period of time. I believe you said 10 years. And so all that considered, how much time would people who are affected by this have to change their plans or figure out a new plan even?
I mean, it could be pretty instant. We don't know the exact cuts they're thinking about, but some of the ideas that are being batted around are things like adding a nationwide work requirement onto Medicaid, which tends to knock people out of the program just based on paperwork. We saw this happen when Arkansas experimented with it. A lot of people just didn't know about the work requirements and ended up losing coverage, even though they might have qualified. Another idea they have is lowering the amount that the federal government pays states for Medicaid, right? The federal share of the burden. And if they do that, what you could see is the Obamacare Medicaid expansion sort of begin to collapse. A lot of states expanded Medicaid on the condition that the federal share of funding stayed at a certain level. I believe 10 states have a trigger law that would automatically roll back their program if the federal matching funds were cut. And if that were to happen, you would see millions upon millions of people pretty much instantly lose their coverage. So you're talking about fast and significant impacts on a good chunk of the American population.
Jordan, thanks so much for digging into this and the details as well. Really appreciate it.
Thanks for having me.
All week on Wealth, we're covering how to save for retirement at every age across all generations, and we've finally reached the baby boomers. According to BlackRock's Read on Retirement report, 68% of baby boomers feel ready for retirement. Around half aren't sure how much they'll be spending in retirement or how to calculate how much they need. Here to break down what those early 60s savers need to know, we've got Sarah Brenner, who is the Ed Slott & Company Director of Retirement Education. Sarah, good to have you on the program here with us. Let's start with your 401k. What are the options for combining or rolling over those accounts?
Thank you for having me, Brad. Yeah, when somebody retires, when they leave their job in their early 60s, that's a common time when that happens, they're going to have some big decisions to make. And it's really important that they consider all of their options before doing anything. One option that we always hear about is rolling over to an IRA, and that can be a great option, but it is not for everyone. You want to think about all of the possibilities. For some people, keeping the money in the employer plan may be the way to go. If someone's concerned about creditors, employer plans, they are protected under ERISA, and that is the gold standard. IRAs outside of bankruptcy, creditor protection is only available under state law, and that can vary. So if somebody's concerned about creditor protection, staying with the plan, that may be the best choice. Another possibility that many people may not be aware of, taking a lump sum distribution. That might sound crazy, but it can make a lot of sense if you have highly appreciated employer stock in your retirement plan at work. You can take advantage of a tax break called NUA. If you're too quick with the trigger on an IRA rollover, you're going to lose that tax break.
You call the 60s.
For a lot of people, the IRA rollover, that's the way to go. There's a reason why this choice is popular. IRAs are great for access. It's easy to get at your money in an IRA. IRAs offer a world of investment options. Your possibilities for investment choices are almost limitless. In addition, IRAs, they're easy to work with when it comes to estate planning or taking required minimum distributions.
Certainly. And so with those options, you call the 60s a sweet spot for withdrawals. Why is that?
Yeah, we like to call the 60s the retirement account sweet spot. The reason for this is that you no longer need to be worried about early distribution penalties. If you tap your retirement account before age 59 and a half, you are likely to get hit with a 10% penalty. And that's on top of any taxes that you would owe on the distribution. There are some exceptions to the 10% penalty, but those exceptions, those are hard to fit into. So most people under 59 and a half, you tap your retirement account, you're looking at a penalty. After 59 and a half, that goes away. When you reach age 73, you need to take required minimum distributions from your retirement account. In your 60s, you're in the sweet spot. You can tap your money without concern about early distribution penalties, and you're not forced to take money out yet. No RMDs until age 73. So it really is the sweet spot for planning. You have a lot of flexibility. You can take money out of your retirement account on your schedule and not the government's.
Certainly. So if people want to save more in their 60s, what can they do?
A great option is continuing to contribute to your employer plan. If you're still working, the Secure 2.0 Act has created super catch-up contributions. If you're age 50 or over, you can contribute more to your employer plan. But for those who are ages 60, 61, 62, and 63, there's an even higher catch-up limit, and we call these super catch-up contributions. For 2025, rather than being limited to $7,500 as a catch-up contribution, you can put away $11,250. Now, once you reach age 64, that goes away. Those super catch-up contributions, they are targeted, they're limited to people in their early 60s.
Sarah, thanks so much for taking the time here with us today. Really appreciate you breaking this down for us.
Thanks for having me.
Coming up, we'll dive into the impact of diversity, equity, inclusion initiative rollbacks on small businesses and content creators next on Wealth. In the wake of President Donald Trump's campaign against diversity, equity, and inclusion programs, or DEI, we've seen companies roll back their own initiatives. Walmart, Target, Lowe's, Amazon are just a few of the major corporations we've seen reduce or eliminate programs in recent months. Now, consumers plan to speak up with their wallets, with many social media accounts planning a spending blackout on February 28th in protest of these anti-DEI moves, instead asking others to spend at small businesses if they can. Joining me now, we've got Marcus Collins, who is a marketing professor at the Ross School of Business at the University of Michigan. Marcus, always a pleasure to grab some of your time. Want to get your take here and input on what we're seeing play out and how consumers are being vocal, planning to be vocal with their spending, and for some of them with the shares that they hold too, because a lot of these programs have been put to shareholder votes.
Oh, well, it's always a pleasure to be with you, Brad. And I think what we're seeing here is how social change happens. You know, when we think back to the civil rights movement, we think that, at least the way it's mythologized, is that there was an appeal to people's goodwill, to their altruism, that made them change their mind and how they operated against people of color. Well, the truth of the matter is that they attacked their pocketbooks. And this is exactly what we're seeing happen today. I mean, according to the Harris poll, 40% of Americans have decided to shift their spending towards companies that are more aligned with their ideology. The Guardian even sourced that 25% of Americans are moving their spending from brands that they love to brands that are more inclined to be aligned with their ideology. This is about ideological congruence, and it only makes change when it actually has a consequence. And in this country that's based in capitalism, that consequence has to be through commerce.
You know, I was speaking with John Hope Bryant, the founder, CEO of Operation Hope, and he was mentioning that the way for consumers to also go about this is not just to boycott Target, but also go buy up all the inventory of the Black-owned businesses, the entrepreneurs that have sold into some of these mega retailers, and then take it one step further and go purchase specifically from them on their websites as well, so that the shelves are being cleared of their products, and then you're also continuing to support the business. In that congruence that you're talking about for consumers here, how much is this also playing out in trends now that businesses have more avenues, more channels to sell their products and their services?
Yeah, this is about empowering agency. The fact that I can sell directly to a consumer, it obfuscates my dependence on a retailer being the primary way in which my product reaches people. There's different distribution outlets. And I think that actually there's a symbolic gesture that happens there too when I buy only Black products or from brands that are aligned with my ideology in a retailer that I don't want to buy from, so that they see that the product is moving, but people are making a concerted, intentional effort not to buy from you. And it's that level of intentionality that sends a signal, but also impacts the bottom line.
Yeah, absolutely. And we've seen that in some of the Placer AI data as well, as they were looking at some of the declines across Target and Walmart here, leading up to what is the more mass planned boycott here as well. And we've got some of that data on the screen for our viewers. While we've got you, Marcus, I want to talk about something with regard to the creator economy, and especially as some of these efforts and programs have rolled back, there's also an algorithmic implication here too for some of the creators of color that might not get the same amount of either dollars or partnerships, or even just be pushed up in the algorithm high enough on social media platforms, who are also playing a huge role here in making sure that there is equity for so many of the creators of color that are on their platforms.
I mean, 1,000%. What your question gets to is really a philosophical issue with DEI, is that DEI has been reworked and contorted to mean Black or Black adjacent. And if DEI means Black, then anything that is of Black culture, that consists of Black people, will then be penalized with the administration's push against DEI, realizing that DEI actually means diversity, equity, inclusion. And historically, white women have benefited more from DEI than anybody else. So of course, Black creators will be penalized across the board for this, even though their works have long been adopted and appropriated from people who are not of their culture or of their cultural background and have benefited financially from it. So we see these ramifications happen across the board. And the idea here is that just like other technologies, the social networking platforms have enabled creators of color to be able to benefit financially from their works, despite the gatekeepers who historically made that a challenge.
Marcus, great to have you back on the program here with us, and thanks so much for spending the time.
Always a pleasure.
That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination. That comes up 3 p.m. Eastern Time. Don't want to miss it.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
It's time for Yahoo Finance's Market Minute. Tech stocks are rebounding here, leading the NASDAQ higher when you take a look at the broader market. All this coming ahead of Nvidia's results after the bell today. Taking a look at Nvidia shares moving to the upside as investors await another critical earnings report from the chipmaker. Options market showing that results could trigger a move of 8.5% in either direction. AppLovin is selling off following after it was targeted by short sellers. Shares of the app marketing company were briefly halted for volatility in earlier trading. Culper Research, one of two firms that disclosed a short position in AppLovin, say that it force feeds app installations onto phones to drive revenue higher. And Lucid shares are lower after the unexpected departure of its CEO. Chief Operating Officer Mark Winterhoff will serve as the EV maker's interim CEO. That's your Yahoo Finance Market Minute. For more on what's trending, scan the QR code below to track the best and worst performing stocks.